more transparency, and this is the year they're going to get it.
Great work over the last 24 hours. Appreciate it. Thank you. Making our job easy. Shonali Basak there, breaking down the earnings on Wall Street. I want to check out euro dollar just before we move on. Check this out. Just breaking down a touch. A weaker euro. Off the back of the accounts released from the ECB, Danny, listen to this. Some members wanted a deeper debate about a 50 basis point cut.
Schnabel also talking about the accounts that the euro drop versus the dollar had been pronounced. It's almost a good thing for them, though, to have a weaker euro. They need that drop. And, John, let me just say, I'm glad you said accounts. One of the first mistakes I made was calling it minutes.
Oh, no, they're not minutes. No, they're accounts.
I felt the heat.
They get very unhappy about that. I'm not sure why. Euro dollar's negative 0.2%, 102.69. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with the latest out of Southern California, where wind speeds have begun to weaken. That bringing some much-needed relief as firefighters try to contain the fires. However, the Santa Ana winds could return next week, which could bring more dangerous conditions. Investigators are turning their attention to a ridge line that overlooks the Pacific Palisades as a potential source to the fires. The area includes a popular hiking trail that was the scene of a small fire days before the blazes spread. Meanwhile, the U.S. Department of Transportation is suing Southwest Airlines for what it says are unlawful chronic flight delays. The agency alleges Southwest violated rules that require airlines to set and meet realistic flight schedules and said it would seek maximum civil penalties. In a statement, the airline said that it's disappointed that the DOT chose to file a lawsuit over what it says are 2 flights that occurred more than 2 years ago. Southwest also saying it's open to discussions about a reasonable settlement. And a group of investors led by LeBron James' business partner Maverick Carter is aiming to raise $5 billion for a new international basketball league. Bloomberg has learned the league would comprise 6 men's and 6 women's teams with games played in 8 cities around the world, modeled after Formula One's global rotation. The league is aiming to ultimately rival the NBA. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes. Up next on the program, the strength of the U.S. economy.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, on a very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now.
That conversation up next, live from New York. You're watching Bloomberg TV.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equity futures on the S&P positive by 0.1%. It's a clean sweep on Wall Street. Another set of decent numbers from another big bank, this time Morgan Stanley. Elsewhere in the bond market, yields are higher by 2 or 3 basis points. The 10-year 467.97. Under surveillance this morning, the strength of the U.S. economy.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, you know, the economy itself looks pretty good right now. It's got a lot coming up on the plate here, but overall, feel pretty good. I think the most important is the labor market.
So here's the latest this morning. U.S. core CPI numbers coming in below expectations in the last 24 hours, boosting bets the Fed will cut sooner than previously anticipated. Another round of claims and retail sales data drops at 8:30 Eastern Time. Francis Donald of RBC disagreeing, writing, RBC Economics is no longer calling for any more rate cuts in 25. And the reason is simple. In our base case, the data simply won't give the Fed enough justification for further easing. Francis joins us now for more. Francis, good morning.
Good morning.
Did CPI yesterday change the story at all for you and the team?
No. Inflation is going to move downwards, but it's not going to get below the Fed's target. And more problematically, what is the balance of risks in the later part of this year? Everything I've heard about in the last 24 hours, the CPI was marginally below consensus. It's a game changer. First of all, the data was not a massive game changer in and of itself. But here's the issue, John. If we were just looking at a normal economic cycle, that would be one thing. We'd say, the economy's behaving like it's mid-cycle. This is the trend in jobs and inflation. But we know that there are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming. So where we are in December or January or February is far less important to the Fed call or the longer term market call than anything we find out next week when President Trump takes office and we start to get more of a sense of the sequence of his policy, the size and the scope of the policies ahead.
We've said it repeatedly on the show with guests, with yourself, the most important data point this month, perhaps this year, is Monday. It's inauguration. When you think about sources of inflation, and we had this conversation yesterday on the show, labor, energy, goods, services, where we're set up right now, where do you think we are most inflation prone when you start to think about policy changes?
So the inflation story is actually fairly simple. Goods are no longer going to be deflating. We know that housing is short on supply, so that OER number is going to keep a floor underneath it. And we got a heck of a ton of fiscal spending and the lagged effects of prior fiscal spending that's going to keep services alive. The labor market just doesn't have enough people. It'll have even fewer people moving forward. So that's the state of play where we are now. Now, the challenge is some of the policies that we know could be coming forward actually are disinflationary, things like deregulation or any policies that help you increase productivity. But things like tariffs and immigration reform, those policies actually will increase inflation, and the magnitude depends on things like how does the US dollar move and other factors surrounding it. So the sequencing of effect, we've talked about this before, the sequencing, do we get the disinflationary ones first or the inflationary ones next? That's gonna be really important for 2025, but looming over this more normal cycle that we're entering for the Fed is the threat of these disruptors that are coming through, and on balance, we see them as being more problematic for upsides to inflation inflation than downsides.
Well, we know some number of Fed officials take that into account. How willing do you think the Fed is going to be not reactionary, but be preemptive when we understand some of the policies coming from Donald Trump?
Well, historically, they've told us we don't do that. We wait for the actualized policy to come through. And Chair Powell has been very clear, we actually want to see realized data. And just how tariffs filter through into the economy, we're still learning. We got a little bit of experience. You know, economists know a lot about washing machines from 2018. We know about steel and aluminum tariffs. And we know that some of the currency can actually provide an offset, and how retaliatory other countries are also matters as well. So there are too many factors when it comes to modeling how a tariff impacts inflation for the Fed to respond proactively. But we've already heard them. We've already heard them through their balance of risks in the SEP, through some of them already incorporating that they know the risk of a tariff is not that it creates deflation, but that it creates inflation. Meanwhile, the labor market, it's looking kind of tight, even though there are some particularities, like layoffs are very low, but hiring is also very low. There's some really interesting things happening there. And this is a Fed that's going to be very aware, the market needs to get up on this, that this is going to be a supply-constrained labor market, so you're not going to have a significant increase in the unemployment rate, even though there may be some interesting factors under the surface there.
Personnel is policy, and today we're going to hear from a key personnel from the Trump administration, incoming Trump administration, that's Scott Bessent. What do you want to learn from him as an economist?
Well, I want to understand the magnitude around some of these themes. So are we talking about things like 25% across the board tariffs, or are we talking about selected industries? And this is really important if you're trying to model these types of developments, because we're trying to figure out what are the primary industries that are hit and then what are the secondary knockoffs. We're probably not going to get that detailed policy. And this is the really core component to the uncertainty tax that will weigh on the U.S. in the next few months. One thing that I do expect is a combination of uncertainty, really slowing a lot of decisions, but then also some inventory hoarding. We saw that before. When you expect the price of something to go up, or you're an industry that suspects maybe I'm at risk here, could actually see inventories rise. So there are so many underlying factors, and what's so critical is these are not typical cyclical developments. So your typical cyclical economic model is not helping you here. You're making an excessive amount of assumptions that are coming through. We have to do some element of that, and that's why a lot of these base case forecasts that went out in the 2025 outlooks, including ours, appropriate modal forecasts, but to stay wedded to them right now, I think is too dangerous.
Just to put a bow on this, because the inflation, the stickiness that we have seen, a lot of it has been because of demand, that the consumer is still spending, the labor market is still robust. Does that shift, is what you're describing a supply shock? Is that the form of inflation that we'll take? And what does that mean for the Fed's ability to fight it and our ability to cope with it?
A beautiful question. And this is the most important macro theme for me for 2025. You talked about a bow. Let's put 10 bows on this. The U.S. economy is moving from a demand-led economy, the one that we all learned about in our economic textbooks, the one that created a Federal Reserve that said inflation is too hot. Let's slow the economy with higher interest rates, to one that is much more similar to a lot of the things we experienced during COVID. A labor market that doesn't have enough people, enough of the skills qualifications to fill health, enough of the immigration to fuel the retail, leisure, and accommodation area. This is going to be important to labor. And then on industry and manufacturing, it's not going to be about can we get, or do we want to have those intermediary goods? It's going to be, can we actually access them? So some of the lessons from COVID with different magnitudes are going to be very relevant here. And what's really critical for us is, how does the Federal Reserve respond, not just in the next 3 months or 6 months, but in the coming years, to an economy that is more supply-led and, dare I say, less interest rate sensitive. A little bit of an existential crisis for central banks, I think. We'll see as we go along. Another area of uncertainty, not just what will the data do, but how will the Fed respond to it. Lots of clouds and fog happening right now.
What do you think of how they've managed the message over the previous 2 meetings around the incoming administration?
Well, the challenge is, when I'm looking at a SEP, or I'm trying to understand the Fed's decision-making function, what Chair Powell explained to us is that they're all taking different approaches within the Federal Reserve. So we don't really have a lot of clarity there. One of the challenges for the Federal Reserve is they've been very clear, we are data dependent. We want to see what the data does month to month. So then you get these huge outsized moves around things like CPI because of a decimal point off on the month over month. And then guess what we get? revisions. We find out that there are seasonality distortions. Now we're going to go into January and we have a massive weather event, a horrible tragedy in California that's going to disrupt all my January data. So there is a little bit of danger with the data dependence comment in an era where we know seasonality, revisions, low response rates, and a myriad of other problems create less clarity around the month to month.
And there's a real sense that they're hypersensitive to the incoming information. And to Francis's point, Danny, that's why we're seeing these big moves in financial markets day to day, data point to data point.
And it's a criticism that the likes of Mohamed El-Erian has levied against the Fed, that the reason you're seeing this instability and volatility in financial markets is because what the Fed is doing. But it goes back to Francis's point. How do you have a longer term outlook when you just don't know what the consequences of tariffs will be?
We're going to have a lot of questions for this guy right here, the former Fed Vice Chair, Richard Clarida, joining us very, very shortly, together with Colin Martin of Charles Schwab, Samir Samana of Wells Fargo, Tom Fitzgerald of TD Cowen. A special thank you to Francis Donald of RBC. Equity futures on the S&P just about positive, the third hour of Bloomberg surveillance. Up next.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
economy doesn't feel that strong, yet the Fed seems to be responding to that.
Everywhere I look, I see more inflation, not less inflation.
We're pricing in a stronger U.S. economy for longer.
Economic paralysis isn't really our outlook. We think we're going in with significant momentum.
The economy's been resilient, and it demonstrates that it might be able to continue to grow right through the end of the decade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Equity futures on the S&P just about unchanged. We're holding on to some gains from yesterday, the biggest one-day gain going back to early November 6th, the day after the election result that went Donald Trump's way. We're looking ahead to Donald Trump's inauguration on Monday. Equity futures elsewhere in the Nasdaq positive by 0.16%. For the financials, it's a clean sweep on Wall Street. Every single bank we've reported on has delivered an upside surprise. Morgan Stanley, the latest. That stock is up. Danny, up by 1.26%.
It probably would have been up more if not for yesterday when all the banks had this huge rally, when we understood the scope of these numbers. Because, John, it is coming from everywhere. It is their trading figures blowing it out of the water thanks to the volatility in the fourth quarter. It is investment banking with the animal spirits of deal activity about to be unleashed. It's buybacks and shareholder returns thanks to maybe a more friendly regulatory environment. And it is their normal Main Street businesses, too, that the credit quality is getting better. It's hard to find an area that doesn't look positive.
Stock is up at a pre-market. To Danny's point, it was up almost 5% in yesterday's session. The next stop for this market is the economic data. A lot of those gains yesterday weren't just built on the bank earnings. It was built on a downside surprise on CPI. So look ahead. We've got retail sales and jobless claims. And then at 10:30, an important one. It's a hearing on Capitol Hill with Scott Bessent.
And this is what I think a lot of individuals are waiting to hear, to try to understand whether it's sequencing, whether it's policy priorities, or actually what is going to be the policy. Everyone comes on this program and they say the market is pricing in all the good stuff from Trump. But what about what the market views as the bad things? These are tariffs. Are we going to get any sort of clarity today from Scott Bessent? You know he's going to be asked about it, whether or not Donald Trump is going to come in and go for the blanket tariffs he promised on the campaign trail, or is he going to take a more gradual approach that Scott Bessent on this program, and I think August, was talking about?
Back in August, yeah, earlier in the summer. Another aspect of this conversation later, the Treasury market. What are they going to do with this debt? How are they going to term out the debt, even if they want to? A lot of it is short-term debt, particularly under Treasury Secretary Janet Yellen. Yields are rising this morning by 3 basis points. Already this morning, a lot of investors focused on that aspect of things.
Because if you're terming out the debt, the implication is that longer-term yields are going to be going higher. So now is the time that you want to do that. Scott Bessent, Nouriel Roubini, a lot of people had criticized Janet Yellen for concentrating in the T-bill part of the market. Whether that's right or wrong, it has happened. And it means that a lot of debt is coming due in a short maturity. Scott Bessent said he wants to term it out, but he also said that he wants to not have longer-term yields go up too much. I'm not really sure how you can do both because it's a supply issue. More debt on the longer end, yields go higher.
He's done a lot of daggers at Secretary Yellen, saying they're trying to juice the economy ahead of the election by holding down this longer-term debt issuance. A question he will probably be asked, will you be, quote, regular and predictable in your approach when it comes to debt issuance?
Debt issuance, not something else. Treasury yields lower aggressively yesterday. Too early for that. Yields up this morning by a couple of basis points. Coming up on the program in the next 60 minutes, Samir Samana of Wells Fargo with stocks looking to add to recent gains. Tom Fitzgerald of TD Cowen as Southwest faces a federal lawsuit over flight delays, and the former Fed Vice Chair Richard Clarida on the latest economic data. We begin this hour with stocks higher, notching their best close since the post-election day rally. Samir Samana of Wells Fargo saying, look no further than better than expected CPI to see just how sensitive stocks and bonds are to incoming inflation data. The Fed has flexibility to cut interest rates further, but we think inflation's rebound will limit the interest rate cuts to just one in 2025. Samir joins us now for more. Samir, welcome. We caught up with Frances Donald of RBC. Asked her if inflation data yesterday changed the story for her at all. She expects no cuts in 25. She said it does not. Samir, how much did that little downside surprise on CPI change the story for you?
Not very much. I mean, look, we came into this year with the thinking that inflation would probably hang at a level higher than what most market participants expected. We have one more rate cut kind of penciled into this year, but again, the downside risk is that we don't get any this year. But I guess what we've been telling clients is, if it's for the right reasons, right? If it's because it's an economy that's on otherwise solid footing, if it's because, things are really good from a policy standpoint, then it's not as much of an issue if the Fed doesn't cut further.
So, Samir, what would you chase, the equity move or the bond market move in yesterday's session? Would you chase either?
I think we're on the equity side right now. Our year-end target is 6,600. If you kind of run the back of the envelope math, it's kind of in that, low to mid-teens once you throw in kind of the dividend yield. On the fixed income side, we don't see rates coming down a whole lot. Our year-end target is 4.5 to 5, so you're kind of in the middle of that range now. And again, if it's for the right reasons, we think the economy and the markets can handle those higher interest rates.
How much of what we're seeing in the move higher in yield, Samir, is just because of this volatility? That if the bond market has this type of volatility, that you can get CPI that comes in unrounded 0.002% away from being unchanged with expectations, that it moves this much, how much do you just need to demand a higher premium in this bond market for that very fact?
Yeah, I mean, look, you can see it in the 10-year term premium, right? It's finally positive, and it's positive by a good bit. Now, I think it's also interesting to note that, it's still below its historic average, so you could have it go further. But I think it's bond investors waking up, for 30, 40 years, they kind of just got positive returns as yields continue to just grind lower, and they've got to kind of sharpen their pencils a little bit and consider that now that we're in a world where rates could remain elevated, and you might be in a range as opposed to, kind of an uptrend or a downtrend.
Samir, I've heard that before, this idea that the bond market had been boring. But the way that I usually hear that play out is that it means that the vigilantes are gone, that everybody's an indexer in this bond market now. All the excitement has disappeared. So the people who would usually pressure the government before aren't existent in that bond market anymore. What do you make of that argument?
Yeah, I mean, I would say maybe they were dormant. Maybe they got a little complacent. But I think now, I go back a little bit to, what you said about, banks firing on all cylinders, right? You've got the term premium moving. You've got the inflation premium going higher on kind of inflation expectations if you look at one-year swaps. You've got the real component moving up if you look at tips. So you've got almost all the things moving towards higher yields. And so I think, before it was maybe one or two of those different things. But now that you've got all three going, I think it's time to really think about, how to position fixed income properly in that scenario.
Samir, John keeps talking about the fact that maybe the most important data point to this market and to investors is going to be the inauguration of Donald Trump next week. Can you just walk us through some of your base case analysis of policies we can expect?
Yeah, I mean, I guess let me at least preface that with, we've always viewed policy as either an accelerant or a dampener. By itself, it rarely makes trends. So I guess maybe let me start with that. But I think it'd be fair to say that you're probably going to see something on the tariff side of things. I think it's probably fair to say you'll see something on the immigration side of things. Now some could argue that that's probably some of the more negative, policy pieces, again, because, taxes and some of those other things will take a little bit of time to kind of implement. That being said, even those policies, if they're announced on day one, it could be phased in. It could be much lower than markets anticipated. It could be something that companies are able to pass along to consumers and it doesn't cause any type of hiccup. So I guess what we're at least trying to do is wait for the policy announcements. We do take President-elect Trump seriously, but until we actually have the policies kind of in hand, it's hard to tell exactly what impact they'll have. But I will say, heading into it with a strong economy, with strong earnings growth, again, it could be a dampener. I don't think it'll be a derailer.
So you take him seriously, but do you take him literally? Say 60% on China?
Clearly that's the one area where both sides of the aisle agree on. But even with China, it does seem like he's looking for a deal. It doesn't seem like he really wants to, kind of end the trading relationship. So I guess it depends. If they start to phase something in with China, let's say, I think the Ruber, last week was, or earlier this week was 2.5% to 5% every month. Maybe, again, that's how they choose to do it. And if the Chinese are okay with 60%, because they find some workaround, then, you could see that level of tariffs. Again, that's not our base case, but it's something that, could possibly happen.
Samir, he's not running again. He's got 4 years. Do you think parts of Wall Street, from the conversations you're having, are underestimating how quickly this administration is going to want to move?
I think so. And look, from that standpoint, and this goes back a little bit to almost all these policies and them being either kind of a dampener or an accelerant. Look, right now, they're accentuating a lot of what we've seen over the past 3, 5, 10 years, right? You want to lean into the U.S. You want to lean into large caps. You want to fade emerging markets. You want to be more cyclical. You want to kind of fade defensive. So I think the really nice part for investors is they're kind of amplifying what's already kind of been the positioning or the right way to position. But yeah, I think you're right. I think that is, where the risk is that the markets are maybe underappreciating how quickly they're going to move with the fact that they've had, almost 4 years to plan for this.
If the markets are underappreciating it, where is it showing up, Samir? What looks mispriced that's not fully appreciating the risk of acting quickly.
Well, I think that's what's so fascinating is the market is almost acting exactly as it should, right? Emerging markets have been very weak. EM currencies have been very weak. If there is a place where maybe it's underappreciating a little bit, I think it's still going back to the rate side. If you really have strong growth and you have an upside skew to inflation, I think you could see an overshoot in interest rates on the long end.
Hey, Samir, appreciate your time. Samir Samana of Wells Fargo, focused on the long end and a possible overshoot. We have seen 5% a couple of times over the last week. We're south of that level after yesterday's rally post-CPI. We're down about 490 to 490 from around 5% where we were trading. We're down a few basis points, up a few basis points on today's session, down aggressively in yesterday's. Connor Sen, one of my favorite columnists on Bloomberg Opinion, out with this morning. Watch the White House, not the Fed, for signs of if and when the next rate cut will come. Saying this, the inflation genie is moving to the White House. Price and wage trends point to the Fed hitting its target this year, but whether it gets there now depends on Trump. And Francis Donald of RBC basically on board with that view.
I think it's so important. Also, the question you asked to Samir, is the market underappreciating how fast Trump will move? I think there's this hubris among investors being like, we're so smart. Whatever Trump says, we can see through it. We understand that it's bluster. But is it really bluster? If you're negotiating with Europe, you're negotiating with China, you can't just get bluster. You have to be serious about it. So again, it seems like the point of this market saying, I don't know, we can see through it, but European and foreign leaders, they're not going to be able to see through it.
Tobin Marcus of Wolf Research just put out a note and talks about expectations you can expect these first few days. And he says on tariffs, not sure yet if this will be a day one, especially conflicting reports and the fact that nothing has been presented yet, according to our report, to President-elect Donald Trump. But he said it's still their expectation that for tariffs, it's big but slow.
Monday's meant to be a day off. I'm not sure Monday's going to be a day off. No, I'm not sure Monday's going to be a day off for anyone on Wall Street.
I don't know about you two.
I think everyone's going to be tuned in to see what happens on day one and day two and beyond through the next 4 years. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. It was a strong fourth quarter for the biggest U.S. banks. Bank of America reporting better than expected fourth quarter results and offering an upbeat forecast for 2025. Morgan Stanley also beating expectations on strong equity and fixed income sales. Turning to politics, Donald Trump's nominee for Secretary of State Marco Rubio signaled that the president-elect is likely to put Cuba back on the state sponsor of terrorism list. Trump gave Cuba the designation before the end of his term in 2021, but just this week, Biden reversed it in a bid to secure the release of political prisoners. Rubio cited Cuba's friendliness toward Hamas and Hezbollah as reasons for the designation. And the biggest names in tech will be among the high-profile guests at Donald Trump's inauguration Monday. Tim Cook, Jeff Bezos, Mark Zuckerberg, and of course, Elon Musk are all expected at the ceremonies in Washington. Their attendance is seen as an effort to build relationships with the new administration, with Apple's Tim Cook particularly interested in avoiding new tariffs on iPhones and regulatory crackdowns on its App Store. That's your Bloomberg Brief. John?
Yahara, thank you. Everybody wants a carve-out, don't they? Everybody does. There's this really odd tension that's going to take place next week between the World Economic Forum and inauguration. And these CEOs are placing their bets. They know where they want to be. It's not the WEF. It's down in Washington, D.C.
It's in front of the Capitol and seeing Donald Trump get sworn in as the 47th President of the United States, especially when it comes to someone like, you have to imagine, Apple's Tim Cook, looking maybe for that leverage to get a carve-out. How important and how critical are tariffs going to be on his bottom line? Also, add to that list, the TikTok CEO, according to the New York Times, will also be in attendance.
I was doing some phone calls yesterday, preparing for next week with some guests that we're going to be talking to. Fantastic lineup. We'll reveal it all for you at the end of this week. We'll do that tomorrow morning. And they all said the same thing. They basically said it doesn't really matter what we've got to say right now because on Monday it's inauguration and we'll see what the president's got to say and ultimately we'll react to that.
I was trying to tell the WEF, you need to have the World Economic Forum, maybe D.C., maybe Palm Beach.
Mar-a-Lago.
Better use of their time.
Yeah, I think maybe things are going to move around. Maybe in the future, who knows? Up next on the programme, the Morning Calls Plus, Tom Fitzgerald of TD Cowen as the Department of Transportation slaps Southwest Airlines with a lawsuit. We'll get into the details next.
politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Stocks just about holding on to yesterday's gains. Equity futures on the S&P 500 just about unchanged. In 13 minutes' time, we'll get some data for you. US retail sales and jobless claims. Yields are rising going into that after falling aggressively in yesterday's session. Your 10-year, 468.17. Let's get you some morning calls. First up, Barclays raising its price target on JP Morgan to 330, citing its Q4 earnings as exceeding expectations. That stock pulling back from yesterday's gains. We're down just 1%. Your second call from Bank of America upgrading UPS to buy, noting benefit in its dynamic pricing model and an end to the freight recession. Their stock is up by 1.5%. And finally, Citi downgrading Southwest Airlines to sell, saying its earnings quality and free cash flow is weaker than pre-pandemic. Their stock is negative by 2.1%. Let's stick with Southwest, the airline, under pressure after the Department of Transportation filed a lawsuit alleging chronic flight delays. Southwest pushing back, saying the department's claims are, quote, not credible. Tom Fitzgerald of TD Cowen keeping a hold rating on the stock. He joins us now for more. What's the excuse? How do you say, and welcome to the program, it's not credible? Can't we all just see whether they're late or not?
Well, I think, these are two flights from 2022, which was an extremely challenging year for the industry. It was the real first reset post-pandemic, and you had a massive juniority headwind from all the senior talent that was lost in 2020 and 2021.
Not just Southwest, right?
Yeah,
JetBlue have got their own problems too.
Oh, yeah.
What's going wrong? What is behind that?
It's a really challenging operating environment right now. I mean, JetBlue, they operate, New York and Florida are two of their biggest markets, and those are some of the most crowded airspaces, chronically delayed, like really congested places to operate in. So I think there's a confluence of factors going on.
What do you make of the timing of this lawsuit, though? The fact it's happening in the waning days of Biden's administration, and the fact that a Trump administration and DOJ will have to be the ones that take, DOT rather, have to take this forward.
Yeah, I think there's been a theme of a lot of bark over the last few months between regulators in the industry, and I'd be surprised if the new administration proceeds with this lawsuit. And we're expecting a more collaborative, less antagonistic relationship moving forward.
So overall, a lighter touch when it comes to some of these airlines. What difference will that make for their businesses?
I think they can focus on the day-to-day operations. They're not, distracted by managing these lawsuits. There's going to be a lot less cost, associated with that compliance. So I think it's a positive.
Is it the issue of the airlines, or is it just the fact that too many people are flying and you say it's so congested?
Yeah, I think it's all of those things. I think you've had a less experienced workforce post-pandemic that is getting better every single year. It's a really crowded operating space. The airspace is more crowded. We have an ATC shortage. It's very acute in places like New York, places like Florida. So I don't think you can point to any one issue. And, I think the airlines are doing their damnedest to be running an on-time operation. That's the best way to keep your cost in line.
The JetBlue CEO recently said on this program that the regulatory environment can't get any worse after Biden leaves office. What are you expecting in the airline industry under Trump 2.0? Could we see more consolidation?
I think it's definitely on the table. JetBlue has talked about, at the very least, pursuing some type of partnership in the Northeast, whether that's with American, whether that's with United. That remains to be seen. But a lot of industry folks that we talk to think that there likely is going to be more consolidation among the smaller airlines in the years ahead.
Who's on the playing field? What kind of names are you thinking about?
It could be any of the small cap airlines. It could be a JetBlue, it could be Frontier, Spirit, tie-up, Sun Country, and Allegiant. I think it's harder to say right now, and a lot will come down to valuations and personalities. But I wouldn't be shocked if there is more consolidation in the 5 years ahead.
JetBlue's come up a few times. Didn't they try and establish a relationship with American Airlines a number of years ago?
They did, and it was approved by the Trump administration and then later blocked by the Biden administration.
So you think they have a second bite at the apple?
I think so, and the judge gave them a template of what they could do, and adopting something closer to what Alaska and American have on the West Coast as a preferred model.
Well, a lot of these models are under stress, the ones that don't have the international businesses, that don't have the premium. Bringing back around to where we started this, definitely Southwest is one of these airlines that doesn't have it. They've tried to make some changes. They're stopping hiring in some of the management levels. They've tried to have more spacious seats, more seat assignments. Are they on the right track?
It's going to be hard to do. The second half of this year will be we're getting a better idea of that. That's when the extra legroom seats will go on sale. A lot of the changes this year are more tactical and incremental, adding red-eye flying. They're going to launch a partnership with Iceland Air. But I think the second half of this year we'll have a better idea if the changes are working. But management is definitely under a lot of scrutiny and going to be in the hot seat this year.
Just as sort of a broad commentary on this industry, for those smaller ones that don't have international or the luxury offering, can they do it on their own? Can they transform on their own? Or do we need to see M&A in the industry in order for them to survive in some form or fashion?
I think there's a lot of players that M&A could make sense for. I think there's, we tell clients either go big or go niche, and there are small airlines that I think have attractive niches right now, like a Sun Country, like a SkyWest. But it's definitely a reversal of the prior 2 decades pre-COVID where legacies bled and low-cost led.
We've seen post-COVID just this insatiable demand, especially in services, people wanting to travel. Do you see that withholding in 2025?
I think so. The upper income cohorts are all doing phenomenally well right now. I'm not expecting that to pull back, and I think that plays in well with the secular theme of spending on travel and experiences and services, to your point.
Just to build on the line of question around premium and these other airlines, can budget airlines do premium successfully? I think back to EasyJet and Carolyn McCall. I remember when McCall made it very, very easy for business travelers, and the share did phenomenally well from, I think, 2010 to around 2017. Could we see something similar happen with some of these players?
I'm a little more skeptical. I think it works really well on longer stage lengths and in big corporate markets. I think if you're catering more towards price-sensitive leisure on a short flight, I'm not sure how big the market is for that, but happy to be proven wrong.
Have you got sales on some of those names then? Because those names, and I won't name them, some of them are spending a lot of money to push into premium, and ultimately you're suggesting they might fail.
Yeah, I mean, I don't know if a failure. I mean, there's profitability challenges versus actual bankruptcy. But I think we have more holds. Some of these names are so volatile, and you have short interest approaching 20%. So if things get just a little bit better on the expectations treadmill, the stocks can start to work really quickly.
Favorite stock right now?
United Airlines.
United had a wonderful year last year.
I think they're gonna have another wonderful year.
Why do you think that can continue?
Well, they were only trading around 3.5 times EPS in August, so it's not like they went from 20x to something eye-popping. And I think they're going to be growing EPS well above the S&P 500 for the years to come, and they're a really exciting company.
Does Delta compete?
Oh, absolutely. They're another of our top picks.
Can they sort out the lounge?
The lounge? Have you been to the JFK?
Just make it quieter. Just make it quiet. There's too many people.
You got to get the Delta One tickets.
I know. I've got to spend more money.
Or the credit card, right?
Yeah, that. Does a credit card, does it get you in still? The credit card points? Does it get you into the Delta One lounge?
Depends on the card you have.
Okay. Tom, appreciate it.
Thank you so much for having
appreciate
me.
it. Thank you, Tom Fitzgerald there of TD Cowen on the airlines. That place gets packed over at JFK.
I've tried to get into Delta One so many times knowing that I can't get in, that I don't have a first class seat, but I go and I'm like, I have a Delta flight, I have a card, any chance? I've literally
Even worse, I had a first class seat, but I didn't have the credit card. So they said I couldn't get in.
Wait a second.
Because you were flying domestic. I forget who it was, but because it was a first class seat domestic.
Oh, Americans do that with the Admiral's Lounge too.
It needs to be at least 5 hours long. It needs to be some sort of overnight flight for them to. I've done the same thing. They were like, your flight's an hour, you can't get into Delta One.
But they'll charge you a premium if you want to just sit in the lounge. I think it's ridiculous.
So, I think this is ridiculous too. Flight to Hawaii, okay? So it takes 9-10 hours. And they said it was domestic. And they turned me away from the lounge.
That sounds like a personal thing, because I don't think that's the policy. I think they maybe looked at you and were like, I don't know about this.
I'm just throwing it out there, right? It's important. They've got to fix these things, Tom. They've got to fix these things fast. In just a moment, we'll get retail sales and jobless claims, and we'll catch up with the former Fed Vice Chair, Richard Clarida, and get comments from Colin Martin of Charles Schwab. We've all got a lot of questions about CPI. Just how much does that downside surprise on inflation yesterday change the story for the Federal Reserve, if at all? Francis Donald of RBC on the program a little bit earlier this morning, making the case that it won't. The most important thing that's about to take place is not the economic data, it's the inauguration of President-elect Donald Trump and the policy changes you could see in the days after that. Futures at the moment positive by 0.1% in the bond market yesterday. A tremendous rally off the back of that downside surprise on CPI this morning. Retracing just a little bit of it. Yields are up by 3 basis points on the 10-year, 468.38. In Europe, they've got their own problems. The ECB accounts out in the last hour or so, a discussion about deeper rate cuts. Some officials wanting a bigger debate on a 50 basis point reduction. That unlocks just a bit of euro weakness. Euro dollar down by 0.2%, 102.68. Up next on the program, the economic data from New York City. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
The next stop for this market, the economic data, is just moments away. US retail sales and jobless claims as well. Mike McKee's going to break that down for you in just a moment. Going into it, here are the scores. Equity futures on the S&P just about unchanged. On the Nasdaq 100, up by 0.2%. In the bond market, the downside surprise on CPI yesterday, unlocking a monster rally. Yields down aggressively across the curve by double-digit basis points on a 10-year. This morning, higher by 3 basis points. With your economic data, let's get to Mike McKee. Good morning, Mike.
Good morning. Well, it looks like we had a good retail month, but not a great one. The anticipation was for a very strong retail sales number. It comes in at 0.4 instead of the 0.6 that was forecast. Ex-autos 0.4 as well. Ex-autos and gas 0.3. So we know there's a fairly big gasoline component to all of this. But the retail sales control group does save the holiday season, shall we say. It comes in up 0.7% compared with 0.4 the prior month and a 0.4 estimate. So it looks like the stuff that goes into GDP is the stuff that did well this time. I'll get that data for you in just a second, but we'll pass on also that import prices were up 0.1% and ex-petroleum up 0.2%. That's reasonably good news because buried in there somewhere is international airfares, and the international airfares are something that contributes to that PCE. We saw a big rise in airfares in PPI, so this will show us whether or not PCE comes in softer or harder. Finally, Philadelphia Fed, the Philly Fed comes in at 44.3 after a negative 16.4. Major turnaround in the Philadelphia, New Jersey area. The prices paid index is at 31.9, though that comes up from 26.6. So you got an inflation signal there. You can make of all that what you want. And while you talk to Dr. Clarida, I'll look up where the retail sales numbers were good or bad.
Mike McKee, thank you, sir. You stay close. Jobless claims came in a little bit firmer than expected at 217, still exceptionally low on a historical basis. The estimate was 210. The previous number revised 203. To Mike's point, headline retail sales, the advanced month-over-month read, little downside surprise, 0.4% against an estimate of 0.6. But the one that matters for GDP, the control group comes in at 0.7. The estimate was 0.4. So the bond market gets whipsawed all over the place, and these are the scores in the Treasury market right now. Yields are a little bit higher still at the front end by 3 basis points on a 2-year, and as you were on a 10-year as well, up by about 3 basis points to 468. Euro dollar dancing around a bit, but basically unchanged as we were going into the print, 102.66, and equity futures just about positive, down on the S&P 500.
Let's be honest, this isn't a huge catalyst, not least of which because the numbers are basically as expected. They don't change the economic picture. But if you were going to trade this, you could get whipsawed yet again in 2 hours' time when we hear from Scott Bessent and his confirmation hearing, and then get whipsawed again on Monday. So I think it's a very cautious time if you're a trader in this market, trading on economic data.
Let's speak to a man who can settle things down. The former Fed Vice Chair, Richard Clarida, joins us now for more. Rich, good morning.
Glad to be here.
It's good to see you, sir. Let's start with the economic data, not just this morning, but of the last 24 hours. Does it change much for you?
Well, you'd like to get some good news on inflation occasionally. We've had some negative prints, and so I think it was a positive. Inflation's still running, I think, hot, but the Fed will be looking for a return to getting on that bumpy road down to 2%.
Do you think the trend is uncomfortable, or are you comfortable with the trend right now?
I'd be a little bit nervous. The Fed put a lot of weight on the fact of seasonals a year ago. Well, we had 3 bad months of data. The last 2 or 3 months of 2024, the data wasn't going in the right direction. So I do think we're on a path to 2%, but the road may be bumpier than folks thought a couple months ago.
To that point, it's been this narrative whipsaw. It's been back and forth. It feels like we're either scared it's going to be a recession or the economy is running too hot. Do you believe that the economic data is actually that uneven, that we can have such different turns in the narrative just 1 month apart, or is something else going on?
I think it's both. I think we've been through a very unusual period. We've had a lot of aftershocks from the pandemic, including inflation. We've had a lot of good news in the U.S., very strong productivity growth, a big increase in wealth, and obviously the Fed is happy that inflation has come down. So I think there is sensitivity and probably a little bit about what to expect for fiscal policy and how will the Fed react.
To that point, should we be looking all of this data at this moment just as a starting point, just as a starting point of what we might get from policy that might add to inflation, might change growth dynamics? Is that the right lens to view everything we're getting?
I do think it is. Initial conditions are important. And so, beginning the year, the economy is growing above trend, 3%, low unemployment rate. And so I think putting policy uncertainty in the context of where the economy is, I think, where the markets need to be.
Should it be what the Fed is doing as well?
Oh, of course. Oh, everywhere and always about the Fed, right.
Well, to that point, how forthcoming should they be? And that's their estimation, that they're looking at the current data and saying, we understand where it is, but we need to preempt where it's going because of fiscal policy.
Great question. And I do think that Jay Powell made the case, especially in November, that they're not inclined to get too far ahead. There's a lot of uncertainty on the details, tariffs, taxes, immigration policy. And I think we are at a delicate point for the Fed because the minutes reveal they did start to incorporate some views on that, but I don't think they'll get too preemptive in this environment. I don't think that would be worthwhile.
Well, in November, Powell said we don't assume, we don't speculate, we don't guess.
Good quote, yeah.
But then in December,
Yeah.
members did.
Yeah.
So how are we supposed to understand this?
Well, the minutes were very revealing and more so than usual, I think, because in fact, if you read carefully, as I'm sure you all did, not only did participants on the committee begin to pencil in some views, but the staff briefings also looked at scenarios for trade, tariff, immigration policy, but also incorporated some of that into the baseline. So they're already starting to try to factor that into the forecast, but I think with a great deal of humility.
You talk about how uncertainty is the only thing certain.
Yeah.
What are you most uncertain about when it comes to Trump 2.0?
Well, I think you look at the three priorities of the administration. What are the details on tariffs? You know, is it a bargaining chip? Is it a battering ram? Immigration policy, I think bipartisan support. We need to fix our immigration system, but the details will be important. And then the budget. Obviously, I think everyone agrees, including PIMCO, that the 2017 tax cuts are going to be extended. But will there be additional tax cuts? Will there be pay-fors? How much of the Biden agenda will be reversed? And so I think you need to look at all three of those.
You're in the perfect seat, because the other question as well is whether this bond market will constrain the ambitions of Washington, D.C. How are you and the team thinking about those forces?
It's very important, you know, we were having some conversation before I came on about the bond market vigilantes, you know, the idea that if Washington's running an irresponsible fiscal policy, you push up rates, you push up term premium, and I think that'll be a very important part of the calculation. Now, bond yields can go up not just because of budgets, because of strong growth and optimism about productivity. So the Fed will have to do some signal extraction. But I think importantly, if yields sell off because Washington's running an irresponsible fiscal policy, then that's part of the way the economy needs to adjust.
What do you think the run-up in bond yields more recently has been about? The data or the incoming administration?
Well, I'm going to be the proverbial two-handed economist. I think there's an element of both. I think that there's optimism about growth, about deregulation. I think that's certainly an element of it. But there's also, I think, concerns about fiscal policy. And we saw that a year ago, and we could be seeing some of that right now.
But you've been writing that bonds are better positioned in 2025 than other asset classes. Does that mean that run-up in yields reverses? Is there going to be a catalyst to help bring us back closer to the ground?
Yeah, so our thinking is that bond yields obviously have been in a range. They've been fluctuating, but we saw bond yields reach 5% about 14 months ago, and then they retraced down. We do think there is an enormous global appetite for treasuries, and there will be a certain level of yields. Last time it was around 5%, where you start to get a lot of foreign demand. And so one of the reasons that we're bullish on bonds, in addition to being PIMCO, is that starting yields are historically the best single predictor of your return on a quality bond portfolio. And starting yields now are attractive and obviously have room to adjust lower under the right circumstances.
John and I have been talking about this hour how it's getting the notice of not just individuals that are part of Trump's economic policy team. J.D. Vance talked about the 10-year yield twice over the weekend in an interview that wasn't even supposed to be financially focused. Is there a level that you think, and I mean, you know Donald Trump, that really starts to unnerve him?
Oh my goodness! Well, I wouldn't speculate on that. What I would say that markets would be focused on, let's sort of simplify it, is, you know, the peak in 10-year yields so far in this cycle has been 4.99%. I think maybe for a minute we got above 5. So certainly if rates, 10-year yields broke above and stayed above 5, that would get a lot of attention around the globe, in the White House and at the Fed and in markets.
Can you help me with something? Because I've got a little bit of a dilemma. I'm trying to figure this out. You were on the Federal Reserve back in the early 20s. So the end of 21, I've got the minutes in front of me. I've got the SEP in front of me too.
Yeah.
December 21, the outlook for the Fed funds rate, the median for 22 was 0.9.
Yeah.
And you ended up hiking interest rates all the way up to 4% at the end of 22.
Yeah.
And this was after President Biden had already unleashed stimulus into a supply-constrained economy. This was after even inflation was climbing up to 5%. The Fed sat there at the end of 21 and said, maybe rates get to 1%. And look at the range of estimates as well on the FOMC. It's really narrow, too. It's anywhere from 0.4 to like 1.1. So it's not like there was some outlier there pricing in a policy change in Washington. Why does it feel different this time with Trump coming back into power? Why was this Federal Reserve and some officials more willing to adapt their outlook, adjust their outlook on policy changes from Donald Trump when they were unwilling to change, even though they'd seen what was coming from Biden? What explains that, Rich?
Well, look, in my own writings and on this show, I've talked about, what at least I was thinking in real time. And certainly by that point in 2021, the Fed had realized that it needed to begin to end QE to start signaling rate hikes. I think there was also an assessment as well about, on the committee and a range of views on the committee, I'll leave it at that, about how transitory inflation would turn out to be. So there's no doubt that in retrospect, the Fed would have been better off beginning to hike rates in the fall of 2021. I think what you need to look at is September versus March of 2022. You need to look at the result and well-anchored inflation expectations. But it was a challenging time, John, not just for the Fed, but also for central banks around the world. The pandemic, the shocks, and the policy response, it was difficult to navigate through.
I think we all just want to be sure that it was just an analytical mistake and not a consequence of political bias.
Oh, certainly not, in my judgment, a consequence of political bias.
Because it is odd that in November the chairman says one thing and then in December he has to say another. And I'm still struggling to explain to people just what changed in between.
Well, again, it was a rapidly evolving situation in terms of the data and in terms of the assessment of the economy. And again, the Fed only meets 8 times a year, so a lot happens in between meetings as well.
Rich, appreciate your time.
Always
fantastic to catch up. Richard Clarida there, the former Fed Vice Chair. Equity futures right now on the S&P 500 just about unchanged. On top of the economic data, Mike McKee, retail sales and jobless claims out just moments ago. Mike, you've got a second look. What do you see?
A couple of interesting things, John. We saw a rise in motor vehicle sales and fall in building materials. Gasoline prices were up. That added to retail sales. But you have to take those out to get to that control group. And in the control group, pretty much everything was up. We saw a big rise in grocery store sales, in general merchandise sales, in sporting goods even. The only thing that was really down, health and personal care. I guess you skipped your haircut, John, during the month. And then when we look at jobless claims, I know people are going to be looking to see what the California impact is. California reported 13,000 extra over last week jobless claims during the week. That's on a not seasonally adjusted basis, but that's one reason that we did see the number go up some, is because this was there were more jobless claims expected than the seasonal factors figured. And then one last thing, the air passenger fares up 10.6%. That'll add to PCE. So overall, a lot of details under the hood, but in general, a pretty good day.
Mike, thank you, sir. Appreciate it. Yields are higher by 2 basis points at the front end of the curve on a 10-year, up by a basis point or 2. Colin Martin and Charles Schwab is with us now for more. Colin, a question we've lent on repeatedly through this morning. Does the CPI print of yesterday really change the story for you?
No, it doesn't, John. And I've heard a lot of the speakers this morning. We're pretty much in the same camp, where it's a step in the right direction, but it doesn't change our outlook right now. It's one report, and that doesn't necessarily indicate a trend. If we look at yesterday's report, it was good news, of course. One thing that we're focusing on was that core CPI monthly print at just 0.2%. That was a nice improvement after 4 straight months at 0.3%. But again, that doesn't change anything right now. I don't think it changes the Fed's view. We'll need to see multiple reports like that before the Fed maybe believes that disinflationary trend has resumed. But once we get to that point, we're already into the second quarter most likely. And when you look at Fed expectations for the first cut coming in the second half of the year, that doesn't change the timing too much. So as it stands today, we're still looking at anywhere from 0 to 2 cuts this year. And the first cut in the second half of the year still seems likely right now.
Does that mean, Colin, a 14 basis point fall in the 10-year yield yesterday, is that something that you'd want to be pushing against at this moment?
We wouldn't necessarily be pushing against it. What I thought was interesting with the drop in Treasury yields was that we didn't see that much of a change in the implied Fed funds futures market rate. I think we're just going to see a lot of volatility. We're in this really sensitive period of time right now with the sticky inflation we're seeing, coupled with the policies from the Trump administration that just throw so much uncertainty. So I think the markets are really walking on pins and needles right now, and every good or bad report is likely to send yields in one direction or not. We think that we'll probably see a Treasury yield, the 10-year Treasury yield, trade in some sort of range, maybe 4.5% to 5%. We do think there is upside from there. So we wouldn't necessarily be changing our view on, a 5, 10, 15 basis point intraday move.
Colin, we've been talking about the volatility of this bond market to economic data, the sensitivity to it for some time. But something is different in 2025. We're not just talking about the sensitivity to economic data. We're talking about the sensitivity to policy, to fiscal policy. What implication does that have? Not just for the bond market itself, but if it's placed in a portfolio, an asset class that is supposed to be a stayed haven in an otherwise maybe risky portfolio if you've got equities and credit in there too.
Yeah, it definitely makes it a bit more challenging to invest today, given the volatility we've seen. And when we talk about what our guidance is in this market right now, especially with all that uncertainty, again, that's a term that a lot of the guests this morning have been using, are you looking to invest from a tactical standpoint or from a strategic standpoint? From a tactical standpoint, it's difficult to get too excited about long-term bond yields right now because we do think there's upside. We think the 10-year Treasury yield probably will touch 5% at some point. I think that's going to be driven by a combination of expectations for the path of Fed policy, but also the term premium, given where it is right now at close to 70 basis points. But from a strategic standpoint, and I want to piggyback on something that Rich Clarida was talking about, the starting yield matters. So something we're talking about with our clients at Schwab are those income payments that you can earn. And whether the 10-year Treasury yield is 4.5%, 5%, 5.25%, we know that the yields right now are attractive to help a lot of investors reach their goals. So we think there is upside. I want to make that clear. And we do favor a benchmark or below average duration. But just because of that potential upside to Treasury yields, we don't want that to necessarily scare investors away from the bond market right now.
Do you think we're going to get any clarity on Treasury issuance and where you think this administration has almost a line in the sand when it comes to Treasury yields today from Scott Bessent as he has his hearing on Capitol Hill?
I don't know if we'll get much clarity there. I think that's going to remain a question mark. Treasury issuance is going to be a challenge right now. I know there's this whole talk about, shifting the maturity makeup, but that can have implications. If you want to start issuing more long-term debt in anticipation of potentially higher yields, you need to find demand there, and that poses a risk in and of itself. And then again, piggybacking on discussion earlier, we know that Trump likes lower interest rates. So how does that play into the path of proposed policies and the magnitude of that implementation? So I think there's just more uncertainty, and I wouldn't expect any clarity today.
Well, this is what is so hard to understand. Donald Trump wants lower interest rates, but everyone says the policies he's talking about may mean the Fed has to remain on pause. Do you think that the fact that he wants lower interest rates, and that if that ends up becoming his North Star, that actually he'll want to front load certainty?
That's a great question, Emery, but who knows? I mean, there's really so much uncertainty, and I don't mean that to be a cop-out answer, but he's campaigned on these set of proposed policies, and any way you slice it, they tend to have an inflationary tilt, depending on the timing, the magnitude. And so how does he square that with the potential rise in yields, which we know he doesn't like, with policies that he has campaigned really hard for, and even now in the weeks that have followed, he's kind of doubled down and said, no, this is what I want to do. So if anything, that just leads to more uncertainty, more volatility. We talk about that term premium right now. It's meant to compensate for uncertainty, and that could be something that ends up pulling yields a little bit higher in the near term.
Colin, appreciate it, sir. Thank you. Colin Martin there of Charles Schwab. I think that's got to be the point of tension in today's hearing, that some of these policies will lead to the kind of things that ultimately Scott Bessent might complain about.
Yeah, exactly. When it comes to things like the issuance, and also when it comes to things like, remember, Donald Trump has a real estate background. This is a guy from New York who wants low interest rates. How many times was he jawboning Jay Powell in his first term? So you need some certainty then if you want the Fed to potentially move on where the economy is, but the Fed might just stay on pause because they're so uncertain about his policies.
I remember a number of months ago, Marko Kolanovic said something important. He said that Scott Bessent's biggest challenge won't be enacting policy change. It will be managing the market fallout that might undermine those changes. And the Treasury market's got to be top of mind.
Well, this is why when it comes to things like issuances, it needs to be regular and reliable, because part of the problem is at this moment, one way to think about things is we know that a change is going to happen. We have a change in administration, we have different policy, and we know said change will have an effect, but we don't know exactly what the change will be, and we don't know exactly what the effect will be. That means you just have to price in a higher premium. To Colin's point, if there's more volatility, you need to have a higher premium. I don't know how Scott Bessent gives us that certainty when ultimately it is Donald Trump that's going to have the final say on these policies.
Bond yields up just a little bit this morning by a few basis points. With an update on stories elsewhere, here's Yahara Heckes. Hey, Yahara.
Hi, John. Let's recap all that data we just got. Retail sales slightly missed during the holiday shopping season, rising 0.4% in December. Economists were expecting a 0.6% rise in spending. Meanwhile, initial jobless claims coming in at 217,000, slightly above the expected 210,000. Meanwhile, Israel and Hamas have agreed to a 6-week ceasefire starting this Sunday. Under the terms, Hamas would release 33 hostages and Israel would pull out of populated areas in the Gaza Strip and release hundreds of Palestinian prisoners. But Prime Minister Benjamin Netanyahu's office is accusing Hamas of reneging on parts of the agreement and saying his cabinet won't meet until Hamas accepts all points of the deal. And some respite for fire-ravaged Los Angeles. The low humidity and dry winds that have fueled the wildfires are forecast to end by midday today. However, strong winds are in the forecast for next week and still no chance of rainfall. The two largest fires, the Eaton and Palisades, have become among the most destructive in California history, leaving 25 people dead and scorching more than 37,000 acres. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, we'll bring you the trading diary, the calendar for the day ahead and a week ahead.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Three-day winning streak on the S&P. Let's see if we can make this day 4. We're positive by 0.1% on the S&P 500. Your trading diary looks like this. At 10:30 Eastern, President-elect Donald Trump's Treasury Secretary nominee, Scott Bessent, on Capitol Hill. Friday, housing starts and building permits. Monday, Trump's inauguration and the World Economic Forum begins. On Tuesday, earnings from United Airlines and Netflix. On Thursday, a little bit more economic data.
So what I hear about, Jonathan, going up to Capitol Hill, having this hearing is like going to the dentist, but only got to do it once in terms of, getting your wisdom teeth pulled. What I will say about Scott Bessent is this is someone that has the backing of the MAGA core, like Steve Bannon, and yet financial industry titans like Stanley Druckenmiller. I think he's going to be able to handle this hearing. We need to know about policy, though.
Let's hope it's not that painful for Scott a little bit later. Coming up tomorrow, reacting to all of this, Erica Najarian of UBS, Jim Caron of Morgan Stanley, Steve Risciuto of Mizuho, and Phil Camporelli of JP Morgan. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It'll be easy, but at least there's a theory of change.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Futures up again after the big rally yesterday, 30 minutes till the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, investors trying to keep Fed rate cut bets alive. Investors are digesting a fresh batch of retail data that still signals a strong consumer.
And the beat goes on. Bank America and Morgan Stanley add to Wall Street wins while HSBC strikes out, cutting bonuses.
And it's not just banks. We'll cover all of the other big earnings, movers, that is, including United Health's revenue miss. All of that and more coming up. Let's take a look at these markets. Of course, like Matt said, slight gains on this screen behind me. Not quite the big rally that we saw yesterday after that CPI miss, but we got retail sales about half an hour ago coming in a little bit lighter than expected. That's giving a little bit of a lift to the big indexes right now. The S&P 500 up about 0.1%. Big tech doing a little bit better. The NASDAQ 100 higher by about 0.4% pre-market. And then you take a look at the bond market. I haven't been here for a few days. I thought we were worried about 5%. Maybe we still are, but we've come down in the past 2 days pretty dramatically. Up a hair this morning, Matt, on that 10-year Treasury.
Remember when we were worried about 4.5%? That seems so comfy now. Yesterday, I was lucky enough to anchor the close on Bloomberg Television. It's the second most crucial time of the trading day. And we saw a massive gain for the S&P, 1.8%. This is every single CPI day as measured by moves in the S&P over the last 2 years. And you can see it was the second best reaction. I will be anchoring the close again today, so do tune in between 3 and 5 p.m.
Had no idea. Matt all day. How fun for everybody. Anyways, some stats we're watching here. Bank of America now down pre-market. Pretty fascinating, down 0.4%. Remember, there was a big rally yesterday. They beat trading expectations in the most recent quarter. Brian Moynihan, the CEO, sees a solid economic environment. He also boosted projections for lending profits. Morgan Stanley still on the rise, 2.3% higher. They also blew past estimates when it came to trading revenue. And of course, we are watching those investment banks just flying this year. However, we don't have all good news across the board in terms of earnings. United Health Group now down 4.3% pre-market. Medical costs came in more than Wall Street expected here. Fourth quarter revenue also missed expectations. The company is reeling, remember, from the murder of a top executive last month, Matt.
All right, so a lot to talk about in terms of really bank earnings are front and center, but also Scott Bessent is going to go in front of a Senate panel today looking to be confirmed as Treasury Secretary. He is going to say he supports a strong dollar policy, which every Treasury Secretary has said since Bill Clinton.
He didn't go that far, Matt. Of course, we're torturing the English language a little bit here. He said that he was talking about the U.S. Treasury's reserve current, or the U.S. dollar, the reserve currency status of the dollar. He didn't go as far as saying he explicitly supports the strong dollar policy.
That is actually interesting, because the only Treasury Secretary that's really deviated from a strong dollar position was Steve Mnuchin, and he only did it for a brief moment, but it caused a little bit of turbulence in 2018. So
absolutely, and we know Trump himself would probably like a little bit of a weaker dollar. The dollar's just been going straight up, it feels like, since October.
Now, what I wonder is if you're going to have congressional representatives here asking him about issuance and the schedule here, because that's something that, of course, he has
You want them to get deep in it, huh?
I do. I like watching hearings. I'm one of those strange ones.
Might be disappointed. I think we're going to get a lot of sound bites.
I don't know that many politicians know as much about financial markets as you do, so I don't see them really going there.
Financial markets have been in their ear.
Yes, for sure. And we have someone, fortunately, with us who knows a lot about it. BNY Wealth Chief Investment Officer Sinead Colton Grant joins us now on the desk. Sonali's worried about issuance, and we'll see that unfold over 2025. What do you think about the level where we see treasuries right now? I mean, I thought 450 was the danger zone, and then everyone was pretty cool about it until we got closer to 5.
Well, look, we should get used to more volatility in fixed income. That is definitely back. But it feels like we're back in the 90s when Treasury yields were around these levels. Equity markets did pretty well, and, you know, bond markets also did pretty well. But the thing that comes with that kind of volatility is really opportunity. You know, if you're an active fixed income manager, this is a great environment for you. And when we think about inflation, which is clearly one of the drivers of what's happening with yield, we had a better print yesterday, it caused yields to come down. We're probably going to hear more about the level of outstanding government debt today in the Bessent hearings. That's another driver. But look, in the high 4s on treasuries, we think this looks pretty attractive.
Let's talk about what that means for the stock market. I'm curious where we are in the 90s, whether we're in the late 90s, because if you take a look at 2000 to 2010 for the S&P 500, it actually fell about 7% on a total return basis. And that sounds scary to me.
Well, and remember what happened at the very start of that decade, which was the tech bubble bursting, right? The dot-com bubble bursting. The two things that drive stock markets, they're earnings and interest rates. Interest rates have been moving lower, and earnings, we think, are going to continue to expand 10 to 15% this year. That gives us a great base. We actually think on the higher end, the S&P can move up to about 6,600 for the full year.
What's going to be driving that? A lot of people are talking about sectors. We are starting earnings season. I know that, Matt, you believe that is only at the end of the month.
No, I mean, bank earnings this week for sure, but earnings season doesn't really kick off in earnest until week after next when we get serious size, right?
Here's my case for why it has very much kicked off. If you have investors looking for a broadening trade, are there clues to be picked up with what we're already seeing right now?
We think there are. Look, we like the tech sector, and we should talk about that, but we also like financials. We see significant tailwinds from what we expect is going to be some reduction in the, or a less stringent regulatory environment. We're seeing a lot of pent-up demand for M&A. That's all going to be positive for financials. We also like some of the industrials. Clearly, that's a cyclical play, but you've got the manufacturing sector, where if you do see production coming back domestically as a result of the Trump administration policies, that's going to boost it too. So look, we do expect some broadening, but we still like tech.
Yeah, I mean, what kind of broadening do you expect? We're looking at estimates of 14% or more for total earnings growth on the S&P 500 this year, but people are saying the tech earnings growth is going to slow down maybe to the high teens, and the S&P 493 earnings growth is going to pick up maybe to the mid-teens.
So look, we do expect some broadening, but tech is still going to be the leader. I mean, we're talking about 40% of the index. AI is a productivity step change, and what you're really going to see this year, it's going to be the show me year, because you are going to have a lot of broader industries that need to make that investment, where they're going to have to adapt or die in terms of AI and the productivity enhancements that it brings. The other thing to bear in mind with tech, often they're referred to as a high duration sector. They're not really, because they've got very significant free cash flow. And when you look at the margin expansion that's happened in the S&P over the last 6 or 8 years, the vast majority has come from the tech sector. So there's still more to come there.
Yeah, great point there on the end, because we've been watching, of course, this rise in yields, and that's where we started the interview. 5% on the Treasury, 10-year Treasury feels a little bit far away at this point. Where does that story still hold, though? What areas of this market needs lower rates at this juncture, and when do you think they're realistically going to see that?
It's a great question. So in terms of Fed rate cuts, we're expecting 50 basis points over the course of the year. So that's probably 25 in Q2 and another 25 in the second half. The area that's crying out for rate cuts is small cap. You've got a lot of non-earners. Even if you're thinking about the debt maturity wall in small cap, that's coming very, very quickly. And if you can refinance debt at, maybe a 6 or a 7 handle, that's better, surely, than an 8 or a 9, but it's still not that much relief. So I would say it's small cap. We're not quite on the, we think it's a little early for small cap.
Really interesting to hear you say that. And it feels like there's two elements needed to really see this big comeback into the small caps. There's the interest rate picture, and there's also, of course, the earnings picture. We heard a lot of bullish people about a couple months ago talking about this broadening out that we were going to see specifically in some of those earnings at these smaller companies. Where are you on that narrative?
There's actually a more interesting side to that, because what people often don't do is take a step back and think about what did the index used to look like? How many public companies did you have in the late 90s? You had about 8,000. Now you've got 3,500. So small cap today isn't the same as small cap that we had in the 90s or even the 2000s. And so that's another reason why you're seeing headwinds because the companies that can choose to stay private are staying private for longer.
Yeah, I was thinking about private markets. That comment really made me want to dive in there. But we have to go right now. Sinead, hopefully we'll have you back and talk more about it. Sinead Colton Grant there, BNY Wealth Chief Investment Officer. Now, Israeli Prime Minister Benjamin Netanyahu says the ceasefire deal with Hamas is in jeopardy. He's accusing Hamas of reneging on parts of the agreement, but the Israeli cabinet isn't going to meet until it believes Hamas has accepted all parts of the deal. We thought, of course, that was accepted yesterday. I guess signing the deal doesn't really mean you believe all of it is important. Let's talk about it with Bloomberg's Israel Bureau Chief Ethan Bronner in Tel Aviv. Ethan, why would Israel say they don't believe Hamas has accepted every part of the deal when I'm assuming Israel or Hamas has signed the deal?
Look, it's a good question. I mean, it's very difficult for us to know exactly what we're talking about. Early this morning, the Prime Minister said that Hamas suddenly insisted that it got to choose which prisoners were going to be released by Israel, whereas that had not been part of the deal. Part of the problem is that we've seen many versions of this deal, and so I can't tell you what was the original deal and what is the subsequent deal. And I don't really know whether the Prime Minister is making more of this than is necessary. He may be, he may not be. He does have pressure internally as well from two far-right parties that are threatening to bolt the government if this goes through. Today, one of the parties said, okay, we'll give you 6 weeks, the first phase of this deal, but then you must promise to go back to war after that's over. Otherwise, we leave the government. If both those parties leave the government could fall. So there's a lot going on, and it may not only be about Hamas's reneging, although it may also be. My instinct is that there will ultimately they will kind of button this down, and the cabinet will approve it. It may not get started on Sunday as expected, but perhaps Monday, although we just don't know.
Speaking of not knowing a lot of these details right now, Ethan, how much uncertainty does this draw, given that there was a lot of hope that was embedded into the moments leading up to this deal in the first place, now seemingly really thrown into the wind?
Look, it's a great question. I mean, people are desperate to have their loved ones and the hostages home. The people in Gaza are desperate to start a day without a fear of bombs and the possibility of getting together and figuring out what's happened to their homes and so on. Look, it's a huge deal. It's such a huge deal, and there's so much pressure internationally that my instinct is that the deal will begin. But I'm not sure. And yesterday I was fairly sure. This morning it looked much less clear.
Ethan Bronner, reporting from Tel Aviv. We thank you so much for all of your time and for all of your reporting. Now, coming up, we're going to switch. We're going to talk about Wall Street's stellar season because it has been continuing. We're going to bring in RBC's Gerard Cassidy to talk about the bonanza that the banks are bringing in. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Time now for the Wall Street Beat. Today is all about the bank earnings. We're looking at Bank of America, Morgan Stanley, U.S. Bancorp, and M&T Bank. A lot of love on that screen. You are seeing intraday Bank of America now up around 2.9%. Morgan Stanley just soaring about 5%. We're going to discuss this with RBC head of U.S. Bank Equity Strategy and large cap bank analyst Gerard Cassidy. Gerard, you look at the way these banks have come to the surface. It looks like Main Street is doing well. It looks like Wall Street is doing well in a lot of these businesses. I feel like investor focus is going to quickly turn very heavily to capital return. How much do you expect these banks to be giving back this year?
Chanel, you're absolutely right that return of capital is very important in our view. And it's interesting you bring that up because the results so far have been very good. To your point, the stocks are moving higher today. They had a very good day yesterday on strong results from the banks that reported yesterday. More importantly, the outlook for 2025, many of these banks are giving more robust outlooks. But the big news, to your point, is how much return of capital is going to take place this year. And it's uncertain, but that uncertainty has been reduced by the fact that the Basel III endgame, which many of the largest banks are waiting for the final rules here, is going to be much less onerous due to the fact that we've got a new administration coming in and new heads of many of the regulatory agencies, in particular, the recent resignation of the vice chair of safety and soundness at the Fed, Barr. He was the one that was pushing for higher capital levels under Basel III, and now he's no longer there. The vice chair of the FDIC in a speech last week indicated that the capital levels should not go up under Basel III. So if this proves to be true by the end of 25, the banks will have plenty of excess capital, and share repurchase programs are going to be very robust in 25 and 2026.
I just want to point out quickly that we do see in the pre-market, Bank America and Morgan Stanley gaining. You can see that on your screen here. U.S. Bancorp, M&T Bank falling. Ostensibly, I'm correcting what Shanali said, but really it's Will Shaker who made the mistake. So
You could have just said our producer.
we blame you. No, I'm kidding.
But we love
I'm kidding around. We showed an
It
intraday
happens.
chart, and we meant to show a pre-market chart. In terms of the big banks versus the smaller banks, Gerard, have we already seen a lot of the money center banks' gains priced in? Because there's been so much optimism, post-election. Or is there more to come in 2025?
I would say that you framed it out well, Matt, in that certainly the expectations and the hope from the new administration has been priced in. And now it's the execution and delivery. And should the banks be able to deliver on the numbers in an economy that's growing, let's call it 2 to 2.5%, and a positive slope yield curve? You pointed out earlier in the program about the 10-year coming down a bit, but we still have a positive slope to the curve. And if the Fed does move in lower rates, so let's call it 4% at the short end of the curve, the banks have not operated in a positive yield curve environment since 2022, and investors may remember that a positive yield curve environment is very positive for the net interest margins and net interest income growth, which will then benefit earnings growth. So it's really going to come down to the execution, because to your point, a lot of the hope is priced in based upon the incoming administration and the policies they will pursue.
Gerard, I'm glad you brought up the yield curve, because this is something I always wonder about. You point out the fact that we're positive when it comes to the 2s10s curve, looking at about 37 basis points. Something I always wonder is that for the banks, is it the level that matters, the absolute level, or is it the direction of travel and the rate of change?
It's a combination of both, Katie. I would say that the upfront curve, when we're down at 0 to 25 basis points and 100 basis points at the 10-year, when you go back to the tail end of the pandemic, that was not a very good environment. But when you can have an absolute level of the front end of the curve around 4% and the long end between 4.5 and 5, that is very positive. So ideally, we would like to see a positive slope to the curve between 50 and 100 basis points, and we'd like to see the front end of the curve stay well above 3%. In that environment, the banks can do very well in building up their revenue growth and profits in that kind of rate environment.
Gerard, I'm really curious as to, out of your coverage universe, your favorite bank to bet on right now, because you do see Morgan Stanley and JP Morgan having significant rises in the last couple of days on these earnings beats, but they're also trading at more than 2 times book. How do you then choose what has the most upside?
It's a good point, Shanali, because that is true. I mean, JP Morgan and Morgan Stanley have done a very good job, but their valuations are at the high end. Therefore, I think there's better value in names that are also putting up good numbers, but just don't trade at those valuations at this time. And a good example of this would be Bank America. Also, the news yesterday with Citigroup coming out with that big buyback program, $20 billion. Citi is a great tactical trade, because we anticipate that as they execute on the buyback, and as we get final clarification on Basel III, there will be even more excess capital for this company to give back to shareholders. And when your stock is trading below tangible book value per share, as well as book value per share, there's no better way of accreting capital to your shareholders than doing a buyback. So if they were to raise the amount later this year, that would be an added positive. So Citi, on a tactical strategy standpoint, is a buy at these levels as well.
All right, Gerard, that's a good place to leave it. Always great to get your insights during bank earnings season. That is RBC's Gerard Cassidy. Now, coming up, Treasury Secretary nominee Scott Bessent faces questions from the Senate Finance Committee in just over an hour. You can watch the full hearing on Live Go or follow our live blog on TLive Go. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Interest. Let's get a quick check on these markets. Just minutes until the bells ring. You can see a little bit of a rally on our hands. The S&P 500, the NASDAQ 100. We got softer than expected retail sales. That pairs really nicely with that miss that we saw on CPI yesterday. A huge rally that we saw yesterday. You're not seeing the follow through in the Russell 2000 right now. Your small caps just about unchanged. What was interesting, you guys, is that you take a look at the magnitude of the gains we saw yesterday. The S&P 500 now in positive territory for 2025, up 1.2%.
Finally. I mean, we were talking about how we've been below that 6,000 level, and it's really been bothering me.
Yeah, we bumped up against it a couple of times this year, but we haven't reached it on an open or a closing basis. I'm really focused on crude.
Are you?
Yeah. So there's a great story on the Bloomberg terminal by Ben Bardenstein, Nick Wadhams about the Trump team readying sanctions, getting ready to try and end the Russia-Ukraine war. Obviously, last Friday, we saw the Biden administration put new sanctions on crude, and it's risen by $5 a barrel since then.
Yeah, we'll see, of course, if that premium is sustained. We know it's hard to price in that geopolitical risk, but stick with us. The opening bell is up next.
CEO right after a vacation than I am before vacation.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading after a blockbuster day yesterday. This is Bloomberg Open Interest. I'm Matt Miller. Futures are still up after a 1.8% gain on the S&P. We're looking at a gain in NASDAQ futures as well, almost 0.5% there. Russell 2000 futures unched, but we saw huge gains for small caps yesterday as well. You hear the opening bell ringing on the New York Stock Exchange. Down there, you've got the national championship ringing the opening bell. That is, I believe, Monday night. You're going to see the Ohio State Buckeyes absolutely destroy Notre Dame. And it's a really big game as well because these are two huge fan bases. Down at the NASDAQ market site, I'm told this is a reality TV star, Bethany Frankel, hugging a young girl, and she's celebrating or raising money for some philanthropic cause. In any case, hopefully she bought the S&P day before yesterday because she would have made a couple percent there. Katie, what do we see in terms of the major indexes?
Amazing segue back into these markets. We have a little bit of a follow-through on that rally that we saw yesterday. The S&P 500 up about 0.1%. The NASDAQ 100 0.4%. Small caps, really interesting. Of course, they are basically closely following what traders are thinking when it comes to the Fed expected rate cut trajectory. We saw some of those bets come back into the market yesterday. Maybe some question marks today because your small caps, the Russell 2000, currently unchanged. Let's take a look under the hood, though, and talk about United Health. Of course, it operates the largest U.S. health insurer. It reported fourth quarter revenue that missed analyst estimates this morning. Now, today's earnings call is its executive's first public remarks since a top executive was murdered last month. You can see shares currently off by about 1.9%, Shonali.
I want to look here also at the banks, of course, reporting earnings this morning. Bank of America profit topped estimates thanks to higher investment banking fees, strong net interest income, a better outlook, yet you are still seeing at the open the shares roughly unchanged. They had a big boost yesterday. Morgan Stanley reported revenue that blew past estimates. Stock is up almost 2%, 1.9% roughly as the market opens. U.S. Bancorp, however, down 5.7%. They had reported sluggish loan growth relative to expectations, increased competition for deposits. We're going to see more of that throughout this earnings season, Matt.
All right, we're also watching a slew of EV stocks. Polestar is one. That's the Volvo unit. They only make EVs, no gas engines, and they had disappointing revenue, and they lowered their annual outlook, so the stock is getting decimated. Meanwhile, the White House and the Energy Department finalizing plans for loans and loan guarantees to Rivian and Plug Power. Plug Power getting a loan guarantee for $1.7 billion to build some hydrogen plants. Rivian will get a loan of maybe as much as $6.6 billion to build its Georgia plant. So those shares are rising, although it has to be said that Trump administration officials, Vivek Ramaswamy has said, will be scrutinizing these 11th hour deals. We're going to speak with the CEO of ChargePoint in the next hour. Rick Wilmer joins us. They have a nationwide network that apparently has developed a vandalism-proof cord, because a lot of times these EV, these EV charging stations are broken.
Yeah.
And they've come up with a solution to this.
Looking forward to that conversation. One of 3 CEOs that we'll be speaking with in this show. So a lot of great stuff coming up.
It's the CEO show.
It's the CEO show. It sure is. We have a great conversation right now, though, because joining us is State Street Head of Equity Research, Maria Waitman. Maria, great to have you with us. I think of you as a pretty bullish individual. So I want to talk a little bit about the start to 2025. It feels like we saw the trade-off between the Trump trade, which really fueled gains towards the end of last year, and now we're back to worrying about the Fed, of course, and whether or not we're going to get all those rate cuts that maybe some of the bulls had been expecting. What do you think is the driver going forward from here?
Yeah, good morning. I mean, you're absolutely right. I've been very, very constructive on outlook for 2025. It's very interesting how sentiment has really swung. At the end of last year, I mean, the biggest criticism I heard from clients is that everybody optimistic. How can you be even more optimistic? And now the pessimism is kind of there, and we've had a big sell-off. I think it's really interesting. The major kind of pushback to the bullish case that we have now on equities is this idea that, U.S. economy is too strong, we're not going to get rate cuts. I mean, I can see how that's absolutely detrimental for a bond market. I mean, for equity market, a stronger economy is still better earnings, which is quite supportive. So I think in terms of key drivers, it's really earnings outlook. And I think it was really interesting in your introduction how you showed some companies that miss estimates are really, really punished and good earnings are very much rewarded. So that's really the story for us, watching for better earnings stories.
Speaking of earnings, there's also the earnings as it relates to the economic data as well. A lot of investors trying to parse through what they're seeing. I want to target here the retail sales data that came out this morning. That came in a little weaker than expected, even with advancing. And then also bring in this whole idea of how the retailers are doing. Target is dropping right now because of an indication here that discounting promotions may have hurt profitability. The holiday season really pointed to deceleration. It's similar to what we heard from Macy's a little earlier this week as well. Do you have any concerns about the consumer and the read-through to the consumer sector, especially because that consumer discretionary sector in particular was holding up the S&P 500 at the end of last year?
Yeah, no, it's a really good point. And again, earnings are the key. Consumer is really important. And what we're seeing is really kind of very wide dispersion in terms of kind of consumer health. So you have one demographic, but maybe kind of a younger consumer, which still needs to buy a lot of goods. So those people need to, starting their families, they're buying houses, they're buying furniture, they're buying electronics. And they are in the beginning of their careers and they more reliant on consumer credit and which is still really, really expensive. So even despite the rate cuts, we haven't seen really significant reduction in credit card costs and things like that. Car loans, so they're still very, very expensive. So that's one demographic, and it's kind of challenged, and we're seeing cracks here and there. And then there is another demographic, people with savings. So they really benefited from higher interest rates, and their savings are good. So consumer is really not uniform, and in general, people with saving, maybe slightly older demographics, they spend more money on services rather than goods. So maybe there is a play there, prefer kind of consumer service to consumer goods. But yes, I think it's very, very company specific stories that need to be watched.
I want to go back to your first comment about the criticisms of the bull case. And I don't think it's all about a strong economy in the U.S., not enough cuts from the Fed. I think a lot of criticism centers around the valuations, right? I get that stocks over the long run are going to go up. But if we're paying 30, 40, 60, 120 times earnings, at some point, it's just too expensive. At some point, a chip maker maybe shouldn't be worth $3.5 trillion or a phone maker worth $4 trillion. At what point do you draw the line and say, okay, we've invested fully and we can't get any higher here?
Yeah, that's a really good point as well. So the way we're kind of thinking about markets is that what we really, really want to buy is companies with quality earnings. So particularly if we are worried that rate cuts maybe are not forthcoming and rates are going to stay high. So where can we find companies that are going to kind of have stable margins and protect the earnings, that may be less cyclical in terms of their revenue? And interestingly enough, those are kind of, so if you look at quality, there is a huge overlap between quality and growth, quality and large caps. So in a way, those really expensive and like tech companies, as an example, they're the ones that arguably are better quality, are somewhat insulated from kind of swings and cycles and higher interest rates and higher cost of living and consumer kind of running out of money. So you have this huge overlap between like quality and growth. Yes, those stocks are expensive, but you want to buy quality if you're worried about kind of economic slowdown. So that's an interesting angle. While if we look at value companies that are trading at a very cheap multiples, they're really the companies where earnings are really, really challenged, and investors are really not giving benefit of a doubt to companies with weak earnings.
Maria, we thank you so much for joining us today. Of course, complicated market to navigate. State Street's Maria Waitman. Now, coming up, what's better than an annual rebalancing? A semi-annual rebalancing. FTSE Russell CEO Fiona Bassett joins us for the latest news in small caps. This is Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Netflix getting upgraded to a buy over at Seaport. The analyst says that the stock should remain a core holding and expects that tailwinds will support its industry lead. Netflix reports earnings next week. Next up, Southwest getting downgraded to sell over at Citi. Analysts note that the airline's earnings quality and free cash flow looks weaker than before the pandemic. And finally, we have Oppenheimer initiating coverage of Mobileye with a buy rating. The firm says that the automated driving company has multiple growth avenues and also that headwinds from China are misunderstood by the street. You can see shares up about 3.2%. Meanwhile, switching gears here, since 1989, the Russell U.S. Index, the world's third largest index provider, held an annual rebalancing. That's all changing. Today, the FTSE Russell is announcing an additional rebalancing date, making it a semi-annual event that will take place in June and in November, beginning next year. Here to discuss, I'm pleased to say we have Fiona Bassett. She is the CEO of FTSE Russell. So Fiona, you've been doing it the same way for over 30 years. Why make this change now in this market?
So good morning, Katie. First off, thank you for having me on the show today. Really great to be here.
Well, look, I mean, as you know, Russell indexes are a hugely important flagship benchmarks for the US equity market. They're not only the broadest, most accurate and transparent representation of the US market, but are also systemically key with over 10 trillion of assets that are tracking these indexes across the investment community. Since starting at the helm of FTSE Russell like 17 months ago now, I spent a lot of time with our clients around the world on how we can best serve their needs as their index provider of choice. And it was evident from those discussions that there was clear demand to move to semi-annual reconstitution. The Russell franchise has grown strongly over time, and reflecting both the demand for US equities, not just here in the US, but across the world as well, as the value proposition of Russell itself.
Right.
We're a strong believer that the choice of index matters.
Right.
And this growth has just, to talk about this a little bit, the growth has generated increased attention to the frequency of the Russell US index reconstitution. To share some stats with you, since 2019, the dollar amount traded at the close of the reconstitution has consistently exceeded 100 billion. And in fact, the June 24 was a record 220. So we've also seen a pickup in US equity market volatility, and based on the client feedback and those market dynamics, we decided to conduct a formal consultation.
Well, Fiona, that's what I'm curious to get your thoughts on, because you talk about the Russell rebalancing trade. It's well known in the markets, of course, in June. And like you mentioned, of course, the June 2024 rebalance, that trading volume of about $220 billion, definitely breaking records there. What impact would you expect this semi-annual rebalance to have on that trade?
So first and foremost, we're doing this because it will ensure the indexes are more dynamic and therefore better representations of the market. We expect that there will be a reduced size of the rebalance for the reconstitution in June, which will also help lower the operational burden of execution. And the semi-annual rebalance will also smooth out the index changes. We've obviously done extensive simulation of the turnover and the transaction cost of moving, which shows a modest decrease at the June reconstitution and a modest increase in the second rebalance. And the feedback from the consultation really indicated that any expected increase in turnover, which we expect not to be material, is reasonable relative to the benefits of moving to the semi-annual reconstitution to maintain the accuracy and representation of the markets that Russell is known for.
Fiona, what does this all mean for the constitution here of these indices? If you look at the types of companies that are making their way up, certainly we have seen certain companies related to AI, even GLP-1, certain hot industries here just take off in terms of how they have been traded. Does this mean that the makeup of the index is changing extremely drastically?
No, not at all. I mean, the fundamental methodology for the Russell indices will actually stay the same. This is really a question of increasing the rebalance to a semi-annual process. And as part of that, to make sure that the index is a dynamic representation of that market. I think one of the benefits of this, obviously, is that and I think the benefit of actually Russell more broadly is it's always been very responsive to changes in the market dynamics. And you can see that, I think, one of the differentiations of Russell, in fact, relative to other US equity market indices is it's not only transparent, but the inclusion of stocks post-IPO as soon as they meet the threshold goes in. So there are a number of distinguishing features of Russell, but we're not expecting the rebalance to materially affect the structure of the index itself.
I'll ask the stupid question, since these two ladies here are so steeped in market structure. Why not rebalance if you want to do it dynamically on a daily basis? I mean, in the age of blockchain, and digital management, can't you do it all the time? Why only twice a year?
Yeah, it's a great question. It's a trade-off really between ensuring the kind of representation and also minimizing the turnover and transaction costs associated with that. And so having done extensive market research and consulted with our clients, we believe the semi-annual process is the best balance for the market.
Is it going to take another 30 years for you to potentially change? I mean, we're at semi-annual right now, and I mean, looking through the press release, one of the reasons you name is volatility. It feels like markets are just getting more and more volatile. I mean, how often do you think that you could make these sorts of changes?
So obviously we review our lineup all the time. We The primary focus is on ensuring that the indexes continue to be representative of the markets. Clearly, there has been a structural pickup in volatility. And I think not just that, but to reflect the growth of Russell and the management of the execution of rebalances, we've chosen to do that semi-annually. Obviously, we'll continue to evolve our index lineup through time. But as I say, we expect this change and the indices to stay the course of time.
So we're talking, of course, about the universe of your U.S. indexes, and one of the most well-known ones is probably the Russell 2000. Of course, the small caps index, we talk about it all the time on this show. I want to talk about the definition of a small cap, because typically people think of about $2 billion, and it just feels like companies are getting bigger and bigger, and you also aren't necessarily seeing the supply of those much smaller companies get replenished because there's been a bit of a drought in the IPO market. Could you see lifting the ceiling on what is considered a small cap away from $2 billion?
So, as I say, we consistently review the methodology to make sure that it's representative of the market. We believe the way that the Russell 2000 is currently constructed, it is fit for the market and its purposes. Clearly, I think one of the interesting things is the potential for pent-up demand around the IPO space. I think one of the things that I think is a differentiator, as I mentioned earlier, for Russell, is the fact that our indices allow for immediate eligibility once they've IPO'd and met that threshold criteria, which, as I say, like if you look at Tesla, for example, is a great example of that in the context of Russell 1000, that when that IPO'd in 2010, we put that straight into the index. And I think if you look at other competitor indices, in fact, actually Tesla didn't make that debut until 2020. So I think we feel very confident in our methodology and that is transparent and allows us to incorporate companies that are growing and meeting the criteria for whether it's small or mid or large.
Fiona, we have to leave it there. We thank you so much for joining us. That is the CEO of FTSE Russell, Fiona Bassett. Now, I want to check on markets here because you have seen them take a leg lower. You have seen them reverse from earlier gains. And we do have, it's not much. I mean, it's pretty much unchanged. However, I do think that the sectors leading the market lower are interesting. You are led lower by consumer discretionary in the S&P 500. That is Tesla, but it's also the likes of Lululemon, McDonald's, Airbnb. Really interesting move after the retail data that we saw this week, guys.
I will note that volume is a little bit lower right now. It still feels like we're in a wait-and-see mode. What we're waiting for, I'm not sure. I guess you could say, of course, it's inauguration, it's the next Fed meeting, it's earnings maybe kicking off in earnest. I know we've had the big banks, but it's a pretty light.
Yeah, I mean, we're getting as I was saying earlier, $3 trillion worth of earnings this week. Next week, a little bit more than $4 trillion worth of earnings. The week after that, $22 trillion worth of earnings. So that's when earnings season really kicks off and we get the big tech stocks. We will be right back with the latest bank earnings headlines. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Checking back in on the bank stocks because today is not as good as yesterday. Despite some banner performance that we've seen, Bank of America is pretty sluggish this morning, only up about 0.25%. Morgan Stanley still flying 1.7% higher. U.S. Bancorp down. Worries about sluggish loan growth over there and more across the regional banking system. I want to show you a chart, guys. Bank of America's book value, price to book, is the lowest among its bigger rivals. You're seeing a hefty premium given Morgan Stanley, JP Morgan trading at more than 2 times book, and Goldman Sachs getting closer to it.
It's amazing to see those price-to-book ratios. I remember not long ago reporting on price-to-book ratios that were all below 1.
Wow.
Now, granted, I was sitting in Frankfurt at the time and
like 50
talking about
years
German
ago.
banks. And they're probably still down there.
Yeah.
But yeah, I mean, that's strong for U.S. banks. And you can see the growth here that we've seen. In white, you've got JP Morgan Chase. In blue, you got Bank America. In red, you got Wells Fargo. And in yellow, you got Citi bringing up the rear.
Does Bank of America deserve to be trading below where Wells Fargo is in price to book? I think that that's a fascinating dynamic.
I would ask you that question because I don't know.
They just boosted their net interest income expectations, and you don't have the market biting. And you know what's
Bank of
interesting?
America did have, what, like a 48% growth in investment banking revenues, so...
Yeah, and at the end of this year, they're expected to bring $1 billion more in a single quarter for net interest income. But again, yesterday you did see the KBW index rise, the most since the election. So...
All right, coming up in the next hour, we have Adam Hetz of Janus Henderson, also the CEO of ChargePoint, also the CEO of Halozyme Therapeutics. All that and more coming up.
Offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
There is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin with good news and bad on fighting cancer. A new report from the American Cancer Society finds the mortality rate from cancer in the U.S. has fallen sharply. Chief Scientific Officer Dr. William Dayhutt.
If we look at the high water mark of cancer mortality, which was 1991, since then, cancer mortality has fallen by 34%. And that means we have 4.5 million cancer deaths averted.
Factors like earlier detection and better treatment both play a part. The report also finds certain cancers are turning up more often in younger women, and Black and Native Americans are dying of some cancers at rates 2 to 3 times higher than white Americans. Israeli Prime Minister Benjamin Netanyahu has delayed a cabinet vote on a newly reached ceasefire deal for Gaza. He accuses Hamas of reneging on parts of the agreement. CBS's Elizabeth Palmer is in Tel Aviv.
The Israeli media is reporting that the delay has largely to do with the Prime Minister needing to buy some time to cope with vehement opposition to this deal inside his cabinet. But broadly speaking, almost everybody accepts it's a done deal.
The ceasefire deal calls not only for the release of some of the hostages, but also for more help for Palestinians. Correspondent Cami McCormick.
For many months, Palestinians have been desperate for food assistance. The ceasefire deal would allow for a surge in humanitarian aid.
We know that the situation is desperate.
Samar Abdul-Jabbar of the World Food Program, which is preparing to scale up aid operations if it is safe to do so.
I think this is just a start. So we're optimistic, and we hope that it will continue and give the people in Gaza the life that they deserve.
Pope Francis has taken a fall for the second time in a month. Correspondent Vicky Barker.
It seems the 88-year-old Pope was in his quarters in the papal guest house when he fell and hurt his right forearm. It was later seen in a sling during his regular audiences. A Vatican spokesman says that was just a precaution. It's only a bruise.
The Pope bruised his chin when he fell and hit it on his nightstand last month. Confirmation, TikTok's chief executive will attend President-elect Trump's inauguration Monday. That's the day after a nationwide ban on the app will take effect, unless the Supreme Court rules otherwise before then. Early this morning at Cape Canaveral.
5, 4.
Jeff Bezos' Blue Origin launched its new Glenn rocket into orbit after a 3-day delay. The company says the success of the mission is crucial to compete with SpaceX. The Dow is down 106 points. This is CBS News.
TradeMasters.com/free.
A lawmaker is proposing a bill that would allow Iowa to buy 9 counties in a neighboring state.
Republican Mike Busolo writes on social media, "Make Minnesota Iowa again." He promises the 180,000 people who live in those 9 Minnesota counties would have lower income, sales, and business taxes in Iowa. He calls for negotiations to make such a deal happen. Busolo says he has a lot of respect for President Trump, but he says he favored buying the chunk of Minnesota long before Trump talked about annexing Greenland. Steve Kathan, CBS News.
Actor Timothy Chalamet was an attention grabber when he rode onto the red carpet for the London premiere of his new movie, A Complete Unknown, on a bright lime green bike. Now he might wish he left those wheels at his hotel. Chalamet tells a French talk show in perfect French he was fined the equivalent of $79 for parking the bike in the wrong place. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. I'm Alex Steele. Paul Sweeney is on vacation. Mike Regan is sitting in. He is the crypto man himself. So we'll definitely get you some quotes on Bitcoin and crypto as we go through these next 2 hours. Plus, I want to highlight that coming up at 10:45, we'll be taking Scott Bessent's nomination process for the Senate Finance Committee live, plus that Q&A as well. Obviously, dollar, treasury issuance, and tariffs all in focus. Let's kick you off now with a Bloomberg Business Flash. And for that, we go to John Tucker. Hey, JT. Don't get the flu. Bye.
Oh,
yeah.
You stay over there.
Yep, I'm over here.
But welcome back. After Wednesday's rally, the major stock averages, they're slightly lower right now. 5 of the 11 major industry groups in the S&P 500, they are up, being led by utilities. NVIDIA, the point leader in the S&P 500 right now. Of course, we did have the eco data earlier today. Retail sales growing at a slower pace than Wall Street had expected for the month of December. And those bank earnings continue. Allison Williams will break it down in just a minute. But Bank of America's fourth quarter profit exceeding analyst estimates. That's because of high investment banking fees, strong net interest income there. Morgan Stanley's fourth quarter profit more than doubling, driven by strong trading revenue. Morgan Stanley shares, they're up about 2%. Bank of America's shares right now, just about 0.1% higher. Cameron Dawson at New Edge Wealth says, stocks have gotten a lift by a fresh slew of earnings and also revival of Federal Reserve policy bets.
What got reaffirmed is that we are still very much in an uptrend. What got taken out or changed in the last 24 hours is the risk that the Fed would be hiking rates at some point in 25 or 26.
Well, S&P 500 right now, 6 points lower, 59.44 in the index. The Dow Jones Industrial Average, 98 points lower. And right now, the NASDAQ 100, tech-heavy NASDAQ 100, that is down 10 points. I should tell you that this business flash is being brought to you by IBKR. Will U.S. oil production exceed 13.61 million barrels per day for November of 2024? You can trade your prediction at Interactive Brokers. Buy yes if you agree, no if you don't. Correct answers earn $1. Go to ibkr.com/forecast. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Mike and Alex.
All right. Thank you so much, John Tucker. Wonderful to see you. This is Bloomberg Intelligence Radio, guys. We're going to get you covered from all angles, eco angles, bank angles, Bitcoin angles, and there we go. Mike Regan, my co-host, he heads up our Bitcoin and crypto coverage. Under 100,000 now, man. Woo, what's going on?
Who would have ever thought
a
Bitcoin for less than 100,000? What a bargain! But
crazy. Talk about that risk rally and then sort of paring back that risk rally as well. We got some economic data today. It looks like we are still spending, not too shabby for December. And we got some initial jobless claims as well. Luckily, Michael McKee, Bloomberg International Economics and Policy Correspondent, is joining us. What's my takeaway from jobless and retail sales?
Pretty good day.
It's okay.
Okay. Joe Biden's
economic victory tour continues. He's getting good data as he prepares to leave office. The retail sales numbers, disappointing on the headline, but that was largely due to things that don't go into the GDP number. We like to look at the retail sales control group, which is the stuff that actually gets counted in GDP, and that was up 0.7, which is a lot more than last month, 0.4, and a lot more than the 0.4 that was forecast. So that was the good news. The jobless claims figures were up, but that was largely in part because of bad weather in the Midwest, but also in part because of the California fires. It appears California jobless claims went up more than 13,000 during the week. That's unadjusted, so it'll show up as one of the biggest movers next week. But when you look down into the numbers, you can see that this is already having an impact. And I think that's going to be a continuing story. We're going to be looking at most of the data to see what the California effect, the Los Angeles effect is.
Yeah, Mike, I feel like there had been so many predictions of doom and gloom for the consumer with higher inflation, higher interest rates. Is it surprising to you to see this much resilience? Or is it just a matter of, hey, the job market remains strong, of course consumers are going to continue to spend?
That is the case. I am a little surprised in the sense that Americans got very used to low interest rates and got very used to discount pricing all the time during the 2010s. And so the fact that they're willing to overlook where interest rates are now is kind of interesting. Now, the people at the lower ends of the economic spectrum are struggling now. At least inflation has come down, but they don't have the money that other people do. So this is driven more by the upper middle and upper classes. But it's still kind of interesting given that we've sort of flipped from the old normal to the new normal and back to the old normal.
Yeah, I think one of the wildest headlines I saw the morning was surprisingly strong sales of Cartier jewelry. So I guess that speaks to that high end.
I guess you talked to Alex about that.
No way whatsoever. Tom Keene was just expounding on that, but to the point that the high end consumer still doing particularly well.
We've seen that, and there was a story today on how European luxury brands are all launching new products and doing well, even though the economy in Europe is much worse than ours.
And China's still a little bit TBD on that as well. What's the next data point you care about? Give me the nerdy view.
PCE is going to be the one that people care about because it will influence the Fed, although it's not going to have any influence on this month, but it could come in about as forecast. Yesterday, we were thinking it would come in a little light, but then international airfares came in high in the month of December, so that might push it up. But at this point, we're all kind of looking to March, and the data point for March comes in on Monday.
Well, speaking of, Chris Waller is on CNBC right now, and he's saying that he doesn't think March can be ruled out for a rate cut. So speak of the devil there.
We could get strong enough growth, and it's just going to depend on how the markets react to whatever Donald Trump does.
All right. Mike, thanks a lot. Mike McKee, Bloomberg International Economics and Policy Correspondent. So the other side of the coin is what's happening with big banks. I mean, these numbers were just tremendous. We've got all of them in, Bank of America, Morgan Stanley today. I mean, Morgan Stanley profit doubling as the company takes some big stock trading beats here. Let's get more on this with Allison Williams. She's a Bloomberg Intelligence Senior Analyst for global banks and asset managers. Okay, what's my word to describe the big banks over the last 48 hours?
Green.
Green. Okay, meaning they're making a boatload of money.
not green, climate friendly. That's a whole other story. But I would say, first of all, the trading numbers, wow, especially for the leaders. Morgan Stanley really coming with that 50% growth in equities trading, but Morgan Stanley, Goldman, J.P. Morgan, really strength. I mean, Bank of America also had good numbers, but especially strong there. The banking fee recovery is what people are focusing on. Not as strong, but really positive comments around the pipeline. Morgan Stanley saying today, IPO pipeline like best in several years, or to that effect. Goldman Sachs also talking about strength in the equities pipeline and the fees there. Really strong. Debt fees actually disappointing a little bit, but they've been sort of carrying the ball for the banking business for a while. So IPO fees, I think, really the strength in the banking pipelines, trading good. But at the core for the banks is better net interest income in the quarter, better net interest income guidance, cost guidance, better than feared for Wells Fargo and Citigroup in particular. That's a key positive. Bank of America talking about operating leverage. And credit solid. We haven't talked a lot about credit, and generally that's a good sign that things are good, but there's not much to talk about.
Yeah, Allison, I wonder if those high trading revenues, is that something typically we see around a presidential election? I mean, I'm assuming that creates a lot of volume that is sort of not indicative of what the rest of the year was like.
Yeah, I think, I mean, especially for, this election, right? So anything that is driving people to reposition their portfolios. So the volatility numbers, if you look at headline volatility, it's probably not, especially for last year, the numbers have been kind of disappointing, but I think just the fact that underneath the surface, there are a lot of shifts in trades and portfolios. So that's been helpful, but the strength in equities trading is the prime brokerage business. Record quarter at Morgan Stanley. Think about hedge funds. They've been hitting a new record in balances. We'll see when the numbers come out shortly if they hit another record, but global equities, the market cap record high in December, right? So prime brokerage, the trades, the balances are, they're paying the prime brokers on those balances. Goldman, Morgan Stanley, JP Morgan, the ones that I said had the blowout trading, they're the leaders in that business, right? We know that a lot of the hedge funds had a good quarter. So to your point, when you're talking about the election, especially some of the macro bets paying off, that really helped the hedge funds, help the prime brokerage.
Which is just in stark contrast to like the PNC and U.S. Bancorp numbers that we got out today, right? Like they're, large regional banks, and their net interest income growth was a bit muted on that loan demand. So if you strip out all that trading that you guys are talking about,
right,
how are things?
And the capital markets, for the big banks that I cover, the capital markets momentum has really been, we talked about trading, banking fees. We didn't talk about wealth and asset management, right? Again, businesses that are helped by high asset values, flows really strong at these companies. So the regional banks of the world, they really are focused on that, the net interest income and the credit. So that solid credit is helpful for them. And the net interest environment and net interest income environment should be helpful to them. But, they're not as strong in products like credit cards. So JP Morgan, Citigroup, Bank of America, even Wells Fargo growing in that business, right? So their net interest margin is benefiting from that loan growth. That's the area where we've seen loan growth. Commercial loan growth is something that we expect is improving. We're getting the benefit to credit of the lower rates, right? Because in commercial real estate, they can refinance, et cetera. But yeah, not seeing those blowout numbers like we're seeing. The last thing, you brought up the election, the less regulation, that's a key positive. And again, that's more skewed to these big banks that had bigger capital rules coming. $20 billion buyback announced by Citigroup. Investors really getting more focused on that part of the story as well.
Green. So you said it green, and it kind of goes all around that. All right, Allison, thanks a lot. Allison Williams, Bloomberg Intelligence. She covers U.S. banks and asset managers for us. She covers all that good stuff. All right, for our listeners in the U.S., here's a reminder for you. Go ahead and listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market research.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stock indexes drifting today following a mixed set of earnings reports from Morgan Stanley, United Health, and other big companies. Morgan Stanley climbing 1.9%. They reported stronger earnings for the latest quarter than analysts expected. Right now, the share is actually up 2.3%. The CEO, Ted Picks's investment banking improved in the quarter. Bank of America also delivering a profit report that beat expectations. The stock there a little more subdued. Bank of America pretty much unchanged right now. United Health Group, those shares slipping. The insurer reporting a stronger profit than expected. Revenue for the latest quarter came up shy of forecasts. This was actually the company's first financial report since the shooting of one of its executives outside New York City hotel last month. A couple of economic reports today. Growth for sales at U.S. retailers, not as strong last month as economists expected. Yet another report that said more U.S. workers filed for unemployment benefits last week. And then a third report said manufacturing in the mid-Atlantic area unexpectedly roared back to growth. And right now, the S&P 500 is down 4 points. Dow Jones Industrial Average down 119. The NASDAQ 100 right now 7 points lower. As far as yields, the 10-year unchanged 464. The 2-year, that's down a basis point. That is at 425. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Mike and Alex.
Thank you so much, John Tucker. Alex Steele here alongside Mike Regan. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, finance, geopolitics, politics through our lens of our Bloomberg Intelligence folks. They cover 3,000 companies and 130 industries worldwide. We also make sure that we tap our great team of reporters all across the globe to really delve into the key stories of our time. And for that, we go to Ethan Broner, Bloomberg News Israel Bureau Chief. And he joins us now. Where are these ceasefire talks at the moment? The reports are coming in fast and furious, Ethan, of issues that keep bubbling up.
Well, Alex, if we could answer that question, it's a great question. Look, we don't know. For at least a dozen hours, the Israelis have been saying that what the so-called finished deal was suddenly reopened, that Hamas was insisting on certain aspects of demands with regard to which prisoners would be released that Israel had not agreed to. That was not part of the original deal. And they're still saying that. The senior officials just a half an hour ago issued a similar statement that Hamas is making demands that Israel will never meet. And therefore, so far, there's no cabinet called to approve this deal, and the deal is on hold.
Well, Ethan, I wonder if you could describe to us what it's like on the ground there as this process unfolds. I mean, is there actually peace and quiet right now, or is there still conflict brewing? Is there still fighting going on?
So there's an enormous amount of fighting going on. Israel has stepped up its military activity in Gaza today. In fact, at one point, Hamas issued a statement saying that one of the female hostages that they're holding where she was being held in a place that had been hit by the Israelis. So, you know, whether that's really true or not, we don't know. But there's plenty of that going on as well. So does not feel like we're on the verge of a real deal. If you forced me to guess, I would guess that they will solve their problems in Qatar, and that by tonight or tomorrow there will be a cabinet approval of this deal. But I'm really not sure.
What is it like in Benjamin Netanyahu's cabinet right now?
Well, I mean, the cabinet is going to approve the deal. He does have two far-right cabinet members who are vehemently opposed to it, one of whom has said he would walk out of the government if it passed. The other of whom has said, well, I would give it the first 6-week tranche that we've talked about, and if you don't promise to go back to fighting after that, then I'll walk. So I think we'll have to see, because it maybe depends on what fighting means and, you know, what will happen. But I think for the moment, the cabinet is secure if they can solve the problem that they say is going on in Qatar right now.
And Ethan, how do you sort of handicap the potential success of this ceasefire deal? Do you suspect that both sides really will agree to it? I mean, we've seen so many times in the past where we thought we had accords that sort of fell through. What do you expect from this one?
I expect failure.
Yeah.
And what does failure look like? I know that might seem a silly
failure
question,
will
but...
mean more of the same. It'll mean that Israel will not remove its troops from Gaza. It means that they will continue to be fighting, that the hostages will be held. Now, of course, then we'll have a new administration in the United States, which in theory is more hawkish and more in line with that. And we'll have to see what that means in terms of what kind of more severe fighting against Hamas is to expect. But that is my instinct.
Do we have an idea of what Israel is going to be, or Benjamin Netanyahu will be talking to President Trump about come basically Tuesday?
Look, I mean, I think that the few things that are most immediate on their agenda are restocking Israel's weapons and so on in terms of its ability to fight. And then the biggest question is what to do about Iran and its nuclear program. So I think those are the things that are going to preoccupy them.
Does the hawkishness on the part of Trump, do you think that will have any impact on how Hamas views this whole situation? Could it actually scare them into compliance or do the opposite?
That was the idea, Mike. I mean, that was sort of the argument until last night, and it may still hold. I think that Hamas is in a much more vulnerable position than it was 6 months ago, not just because of President Trump, but because of having lost its leaders and the fact that Hezbollah is no longer able to help it. The Syrian regime has collapsed, and that Iran is stripped of a lot of its air defense systems. So it's alone. It doesn't have the support system it thought it would have. So in theory, it got more involved with negotiating this deal. But, you know, it's also, a fairly extremist organization that in theory is not afraid of death. And so it's very hard to know.
All right, well, we appreciate all of your insight. Thank you so much, Ethan Broner. He's joining us, Bloomberg's Israel Bureau Chief. Thank you so very much. So we're going to get to geopolitics as well. There was some other interesting geopolitical news in terms of the incoming Trump administration and Russia and Iran and Venezuela. Henry Atreus, Managing Partner and Director of Economic Policy at Veda Partners, is standing by. And, of course, we're counting down about 15 minutes away from the start of Scott Bessent's. He's the nominee for Treasury Secretary in front of the Senate Finance Committee. We'll be bringing that to you in full. Henrietta, great day to chat with you. Let's start on geopolitics for just a moment. What is your base case for ceasefire talks between Hamas and Israel?
I think that we are going to see a last-minute fit and flurry of activity from the Biden camp, and they've gone out of their way to signal how united they have been with the incoming Trump administration. So I think it's going to be in the best interest of both the outgoing Biden administration and the Trump administration to keep this deal on track. And I expect that to exert quite a bit of pressure. The linchpin, obviously, is Hamas. And I think that Biden and Trump have more sway over Netanyahu than they do over Hamas. So it is tenuous, as you guys were just discussing. But I expect to be seeing quite a bit of activity here in the final days of the Biden term and the early days of Trump. He definitely is going to need some executive branch level wins when he takes office.
Henrietta, to shift gears a little bit, obviously we're waiting on the confirmation hearing for Trump's selection for Treasury Secretary Scott Bessent. I'm curious what you think, what type of influence he will potentially be on Trump.
That's a great question. I think the Wall Street community has outsized expectations that he will be a sort of traditional Republican Treasury Secretary, the sort of free trade advocate, but that is very far from what I'm expecting. Not only is he going to be the loneliest voice in the room, but he also supports tariffs. There's been some misunderstanding that his advocacy for slowly escalating tariffs is somehow a muted approach to the president-elect's ideas. But 5% upticks are regular features of all the tariff proposals we saw in Trump's first term, including IEEPA and those 2019 threats against Mexico, which had 5% escalatory tariff expectations for 4 or 5 months. And the same with Section 301, the U.S.-China tariffs. So I don't see a lot of optimism around maybe him being a tempering force the way that the street does on tariffs, and I think we'll see that today.
do we think we're going to hear some of that incremental tariff talk, like 2 to 5% every month kind of talk?
Yeah, I mean, that's what I heard from him back in October. So I would expect him to repeat those claims. 5%, is, as I just mentioned, really normal. You start at 5, escalate to 25 by April, May, June. That's very standard boilerplate from the Trump first term. So it doesn't, to me, speak to any kind of muted tariff approach from the incoming Treasury Secretary. And of course, he doesn't really have sway here. It's Commerce Secretary Lutnick and USTR Jamison Greer.
Yeah, Henrietta, I was going to ask you about that. In the Trump's first term, Steven Mnuchin, the Treasury Secretary, was at least the public face of the tariff negotiations. This time, from all the reporting I've read, it does sound like Howard Lutnick will be more of the lead on that. Is that fair to say, or is it sort of will there be a back and forth between the two, and Trump gets to decide, who he listens to?
Well, first of all, I think that even if Steve Mnuchin was the voice of anti-tariffs, he obviously didn't win in the Trump administration. There are $350 billion worth of imports tariff from China alone, not to mention the Section 232 tariffs on various nations around the world. So at that point, USTR Bob Lighthizer is, the preeminent voice in the room, and Jamison Greer is, of course, his chief of staff from that time, and he'll be the incoming USTR. I think going further, to answer your question directly, the Department of Commerce is, I think, now much more important to the United States executive branch than the Treasury Secretary is. I think also Bessent has the issue of the debt ceiling to address for the next 8 months. And Commerce is well equipped to both dole out funds that are still coming on from either the IRA and those preferences and grants, or the CHIPS and Sciences Act. And then USTR right next to it in sort of the same house is going to be the major block to watch on tariffs, not Treasury.
So if we stay with more Treasury purview for a moment, I know it might not be the sexiest topic in the next 15 minutes, but I'm really curious as to the sanction conversation we're going to hear, particularly when it comes to Russia, Iran, and Venezuela. How aggressive is aggressive?
I think that we've seen two escalations in this sort of universe. That's increased activity from the Bureau of Industry and Security, which is where our export controls are landed. They've been so expansive, and even more so since the war in Ukraine started. And then on the sanctions front, you see that expanding to corporations from China and Russia, but now also individuals. And I expect that list to just grow and grow and grow. There's an excellent book called Treasury's War from the guys at CSIS that I would highly recommend. Sanctions, I expect, will be a major component of how the Trump administration wages the next 4 years.
Henrietta, obviously President Trump has made some aggressive remarks about acquiring Greenland, making Canada a 51st state. I think a lot of people view those remarks as sort of, I don't know if you'd call them bluffs or sort of a Trump wish list item that really just don't have any chance of seeing fruition. But I'm curious how you're thinking about those two storylines. Are they going to go away after the inauguration, or are we going to continue to hear about Canada and Greenland and Trump's ambitions for them?
That's a great question. I think that the Greenland component will always will continue to be there and to escalate, in part because so much of that is going to be focused on military spend. And the first bill that we expect House and Senate Republicans to pass this year is going to be increasing military spend to that complex. And that's not just going to be for the U.S.-Mexico border, but what they call a generational preparedness component on military spending. So for those who are expecting federal spending to be reduced, I would strenuously disagree. The number on increasing defense spending, which could in part go to Greenland, and Trump could try to get that into some of the bill language, has risen from $20 billion, which was originally proposed late last year, to now $500 billion in increased defense spending. So right there is a way to keep Greenland on the radar. And with Canada, I really have all my eyes on the USMCA renegotiation, which is going to come in 2026. So Canada should be expected to be front and center. We are expecting IEEPA tariffs on Canada. I wrote a letter to clients about that last night. IEEPA tariff threats on Canada, first thing, day one agenda item is what I would expect. Canada will then retaliate, and this is a really interesting dynamic for investors. A lot of focus on minerals and critical minerals and whether they put in their own sort of effective levies or export bans on things that we really need, that we don't make domestically: uranium, aluminum, zinc, copper, things like that, before you even get into the critical minerals that we are banning from China, or that China is banning to export to the United States.
Yeah, and we saw that already, sort of the threatening retaliation from Canada, according to people familiar with the matter yesterday. Henrietta, thanks so much. We know you got to go because you got to listen into this confirmation process. Henrietta Trace over at Veda Partners. We are just about 10 minutes away. The hearing is currently starting. We will be getting to Scott Besson when he starts testifying. Currently, we have the chairman, Mike Crapo, giving opening remarks. In the meantime, let's get you a business flash here. And for that, we go to John Tucker. John.
And this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Seeing a pause of yesterday's rally right now. You have chip tool stocks like Lam Research and Applied Materials climbing. This comes after Taiwan Semiconductor Manufacturing set its capital expenditure target ahead of analyst estimates. Bank of America and Morgan Stanley both delivering strong results as the financials continue reporting earnings. And Ken Leon at CFRA says the banks have a much stronger business model than even just a few years ago.
They have a blend of great franchises with durable recurring revenue fees for transactions across many businesses. And then on the upcycle for investing, or really for investment banking, we're seeing the added benefit.
Morgan Stanley shares up 2.3%. Bank of America, down right now about 0.5%. Overall, the S&P 500 6 points lower. That's down 0.1%, 59.43 on the index. The Dow Jones Industrial Average 87 points lower. That is down 0.2%. And the Nasdaq 100 right now 22 points lower. That is down about 0.1%. The pass rate for the second level of the CFA, the Chartered Financial Analyst Test, plunging to the lowest since the pandemic. 39% of candidates sitting for the level 2 test unsuccessful in November.
Yeesh.
It's just sounds like torture to me.
Yeah, no,
I know a lot of people
awful.
have gone through it, a lot of smart people, and they were like, whoa.
I just can't imagine actually doing all that work in prep and then not passing. I don't.
I wondered if it got harder. Were there distractions?
I think it's post-pandemic. The more you wait,
more people taking it. Maybe?
The more you wait, the more
The dumber you get, is that?
I know that's true in my case.
I was going to say, the longer you sit with that information, the more it drains out of my ears. All right, Tuck, thanks a lot. John Tucker joining us. I'm Alex Steele alongside Mike Regan. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. Okay, a couple things coming up. In about 10 minutes' time, Scott Bessent, who is the nominee for Treasury Secretary, will be giving his opening testimony to the Senate Finance Committee. Currently, Chairman Mike Crapo is giving his opening remarks. We will bring that to you live. Also, some breaking news for you. Ashley Moody is to be named by Ron DeSantis to fill Marco Rubio's Senate seat. She is the Florida Attorney General. Again, Ashley Moody, she'll be filling Marco Rubio's Senate seat. Reminder that President-elect Donald Trump nominated Rubio to be his Secretary of State. Let's go now to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. One thing we didn't get to with Henrietta Trace when it comes to Scott Bessent's testimony is what we're going to hear about Treasury issuance. It's not necessarily like a vote getter. It's nothing sexy that the public's going to love and watch on TikTok, but arguably for the markets, it's one of the most important. Do we think we get to that today?
You know, I'm not exactly sure we will. I mean, look, the Senate usually doesn't pay attention to such topics, but I certainly think our clients are interested in that. In fact, just this morning, I had a client ping me and say, hey, will we have a confirmation before we have the next issuances in February? So it's certainly on clients' minds. So I think, you know, you're not going to see a ton of the way of policy, I think, that's going to change and move markets outside of tariffs and maybe a little bit on taxes. But for the policy wonks certainly watching, we certainly want Scott Bessent to get into those details. It's just up to the senators to ask, and generally they don't get to that level of detail.
You know, Nathan, I know a lot of people on Wall Street are expecting a lot of regulations to get rolled back under President Trump's next term. I'm wondering what you think the priorities will be there for the new administration and what realistically they'll be able to accomplish.
Yeah, so this really depends on whether or not you have the ability to control that agency. And what I mean by that is deregulation under Treasury will look different than deregulation under the Federal Reserve. So the Federal Reserve, Jerome Powell is still chairman, and so you would need anything to go by him. So that's why we think over the Fed it's going to be more of a great pause in 2025. But at Treasury, what we're looking for specifically from Scott Bessent, not sure you're going to get to it today, but as of this tax extension bill, there's this idea out there that the Inflation Reduction Act could be at risk. Now, Congress, we don't think is going to touch it, but Treasury has the ability to change the parameters of these tax cuts. So if you're investment in clean energy right now, and a lot of CapEx is coming from non-U.S. companies into Trump GOP states in the South, will Treasury come in and change the parameters of that tax cut? Because they certainly have the ability to do so. Now, it's a process. It's a lengthy process. It's going to take about 9 months if they do it on the quick. We haven't heard any indication that they're going to do that, but certainly something that we're going to be keeping an eye out for, because deregulation can also come from Treasury in addition to all the other agencies out there.
And just to point out, we are now listening to the ranking member, Ron Wyden, speaking. We will be bringing to you Scott Bessent's testimony as it begins. So, Nathan, to that point, you know, I already got sort of the flack for the Department of Loan Office being like, all right, we're heading out, check you later. There's just a lot of money that's going to be put at risk. Do we have an idea of what the budget deficit is going to look like? Because many say the long end, that term premium, is actually rising because of the sustainability issues.
Yeah, you know, this is certainly a question. I think this is one of the main questions that Scott Bessent is going to be asked. In fact, Elizabeth Warren gave him 32 pages of 180 questions. And one of the questions was, okay, you support extending the Trump-era tax cuts, which I think people estimate to be around $4.6 trillion. If you don't pay for it, that's going to add for the deficit. And when you have the Doge Committee and you have Elon Musk and Vivek Ramaswamy and so forth saying that we need to cut, what is Scott Bessent's position on this? Now, obviously, he's going to speak in favorable of keeping those tax cuts going forward. He'll talk about the economic growth that comes from those tax cuts. But eventually, there is this thought here in Washington is you do have to figure out how to pay for some of that. And I think if the deficit continues to grow, you're going to continue to see pressure from the Doge Committee and also the Doge, the allies on Congressional Hill to do something about it. Now, and that just speaks to funding fight. And I would also just remember and remind folks that are listening that any type of funding issue in Congress is a congressional deal, requires a bipartisan act of Congress. And so we potentially could have a government shutdown over that as soon as March 14th.
Nathan, I'm wondering, you mentioned that sometimes the questions asked in these hearings are less than satisfying, especially to policy wonks like yourself. I'm wondering if you could toss in a few questions to this nominee, what they would be.
Well, I think the primary question that I would ask, and this is what Henrietta got to in the first segment prior to this, is on tariffs. You know, Bloomberg News reported just a few days ago that Scott Bessent is pushing this idea of escalation tariffs as an idea to give trade negotiations. Now, there are several ways that President Trump can put in tariffs. The power of the presidency is more powerful there, but a lot of those require a study from the Department of Congress or, a 2 to 3 month lag. So there's a negotiation between the countries that take place before those tariffs come into fruition. However, President Trump does have the ability to declare an economic disaster and have that tariffs take place immediately. All you have to do is go over to customs and change a number and hit the button and hit enter, and those tariffs change. I would like to know from Scott Bessent, do you support a policy in which these tariffs come out strong and come out quickly? Because that's not exactly where I think the Wall Street thinking is. I think the Wall Street thinking here is that Scott Bessent is more moderate voice when compared to Howard Lutnick over at Commerce and the U.S. Trade Representative and so forth like that. So I'm really much interested is Scott Bessent going to use this political capital to try and push a more moderate approach to tariffs, because these tariffs are coming, or does he support or would, essentially allow the Commerce and USTR to support their positions of coming out pretty high and pretty strong?
What we do know is that he's definitely going to focus on the dollar. He already said in his prepared remarks that the dollar should remain the world currency. How does that translate into policy, you think, during this hearing?
You know, this is always the inflation question. Do you support a strong dollar? Do you support a weak dollar? I mean, obviously, President Trump has said that one of his main goals through tariffs is to bring manufacturing back to the United States. But if you have a strong dollar, which he's also said that he wants, it's sort of, you know, hard to figure out where the exact policy is. And I'm hoping that Scott Bessent will be able to give us a position on that. In his prepared remarks, however, he didn't really talk about strong or weak dollar. He said that the United States dollar needs to be the reserve currency of the world. We've seen a lot of movement from the BRICS nations of China and so forth over the last few years about trying to move away from the dollar. You know, President Trump even threatened at one point a 200% tariff on any country that moves away from the dollar. I'm not exactly sure what that means, but we would look for Scott Bessent to clarify on that, because he would be one of the key figures that would be obviously talking to Wall Street, talking to other central bankers across the world about what the U.S. position on the dollar will be for the next 4 years.
You know, Nathan, so much of the narrative around this incoming Trump administration is that, okay, this time he really got the team in place who are true believers in his agenda, the MAGA worldview and whatnot. But I'm wondering if there are any areas of dissent or disagreement between Bessent and Lutnick or any of the other nominees that you expect to sort of come up to the surface once the cabinet is in place.
Yeah, you know, right now I think we're in the, you know, the optimistic portion of the administration. I mean, everybody seems to be on board. Certainly, if you talk to the Republicans on Capitol Hill, they're also on board. But then the soap opera portion, which I would call the soap opera portion of the administration, comes next, because once you start having to making these hard decisions, that's where the fractions will break up. The debt ceiling is a perfect example. Scott Bessent, if he's confirmed, will come out and say at a certain point, look, we need to raise the debt ceiling. But there are 43 Republicans. Bloomberg government did a great analysis just today. There are 43 Republicans that have never voted for a debt ceiling increase ever. And I don't anticipate that they're going to change their minds, even if President Trump says that they need to raise the debt ceiling. So Scott Bessent is going to have to go to the Hill, try and convince those Republicans that this is a way that we're going to have to do this, or if not, he's going to have to help, you know, House Speaker Mike Johnson find Democrats to vote for that increase. So it's certainly going to be a very difficult decision, and I think could lead to some disagreements amongst the cabinet within the White House.
And I can't believe that Mike hasn't asked this question, but what do you think we're going to hear about Bitcoin and a strategic Bitcoin reserve potentially being a priority for Bessent?
You know, President Trump said he wanted to make the United States the crypto capital of the world. You know, we've been fairly optimistic about a cryptocurrency framework getting through Congress this year, but there's this idea that, you know, the United States would create a strategic Bitcoin reserve. And at one point, Senator Cynthia Lummis from Wyoming is heavily involved in this, at one point suggesting the United States should own about 5% of the world's Bitcoin. Now, the United States does own around 213,000 Bitcoin just because of enforcement actions and so forth like that, scattered amongst Commerce and Treasury. But I think instead of declaring a strategic Bitcoin reserve, if you will, and having it as part of the budgeting process, because that would require an act of Congress, I think you certainly could just write an executive order saying, I'm going to create a strategic Bitcoin reserve, call it a group, if you will, made up of Commerce and Treasury. They move that 212,000 Bitcoin around, call that the reserve. But to have Congress actually go out there as a budgetary matter and purchase Bitcoin, that's going to be up to Congress. And again, I remind you, it has to be a bipartisan vote to get that over the line.
Yeah, and I think Lummis had actually floated the idea of selling some of the gold that the Federal Reserve holds to fund those purchases. I know Trump likes gold too, though, so I don't know how
that would pan out.
how that would pan out. But Nathan, I'll shift gears to another cryptocurrency, Doge, or at least the new department that was named after Dogecoin, the Department of Government Efficiency. How do you see this really fitting into everything going on in D.C.? I mean, is this sort of just a perk for Elon Musk to keep him in the MAGA universe and keep him happy, or will it really have an impact on D.C.?
So it really, there's two thoughts. The first thought is that the Doge is not a department. I mean, I call it a committee. It's an outside blue ribbon committee, think tank, if you will, that is going to be able to provide opinions and a report July 4th, 2026, which I would also say is 3 months before the appropriations process is supposed to be completed. So you're not going to be able to get any of those recommendations done. So that's the first thing, is they're just going to be outside of the U.S. government. However, Elon Musk has proven that he has the power of the bully pulpit, and there are a lot of allies on Capitol Hill that will take those Doge recommendations and essentially just turn it into legislation and start passing bills. And the idea here is that coming up to the midterms, if the House Republicans can say, look, we've done all these bills to try and cut from the U.S. government a lot of bloat here, will the American people support that? So I think, in terms of the Elon Musk actually getting involved and saying we're going to fund the Department of Education, that's probably not going to happen because it would require a bipartisan vote, but it certainly could put pressure on Democrats over the next year or so. And I think if the Doge Committee, if they were to start to announce that we're starting to identify $1 billion, $200 billion, $1 trillion in terms of cuts, but it's the Democrats that are blocking us, it's at least a political exercise that I think the Republicans can fall back on.
All right, Nathan, we really appreciate it. Thanks a lot. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. To update you, currently Senator Lindsey Graham is introducing Scott Bessent to the Senate Finance Committee, where then Mr. Bessent will begin his testimony, and we will take that for you and your Q&A as it comes. In the meantime, I want to get you caught up on what is happening in the markets, and for that, we go to John Tucker.
All right, and Alex and Mike, stocks, bonds, the dollar seeing small moves following an almost 2% rally in the S&P 500 yesterday. You have the tech megacaps, they're losing some steam. The banks mixed right now, despite some pretty solid earnings from Morgan Stanley as well as Bank of America. Caleb Pickering, chief economist at Pell Hunt, says, you know what, for the moment, the bond market in the driver's seat for investors.
As markets try to understand what might happen next, we see it through the bond market first, and then that reverberates. What makes me nervous is the big moves on fairly small data point changes.
Right now, the Dow Jones Industrial Average 66 points lower. That's down 0.2%. S&P 500 down a point. The Nasdaq 100 right now 12 points lower. In that yield space, 2-year is down 1 basis point, 424. The 10 is about 2 basis points lower. That is at 463 right now. Also, let's finish with this big win for Donald Trump in South Florida. In a 4-0 vote, the Doral City Council approved the Trump organization's plans to build 5 20-story condo towers at the Trump National Doral Resort. That's that 600-acre Miami property. It's currently home to a hotel and 4 golf courses. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Mike and Alex.
All right. Thanks so much, John Tucker. Alex Steele here alongside Mike Regan. Wasn't Miami or Palm Beach? What was it? What was the new Wall Street of Florida?
I think it was supposed to be Miami.
And then it's still there, but maybe we're pulling back a little bit because there were a lot of infrastructure issues, right? Like housing was a problem, private school was a problem for Wall Streeters moving down there.
Are you saying that at some point New York City is going to be dethroned? How many times have we heard this story?
Maybe we could be the new Miami.
Wait, how does that work? Isn't it like 1 degree outside or something?
Well,
everyone comes back here after they.
Interestingly enough, I just saw the forecast for Inauguration Day in Washington in the 20s.
Yeah, it's 21 degrees.
Yeah,
that's not nice. No,
yeah.
I think our Anne-Marie Hardern will be on Capitol Hill outside that whole inauguration process.
I'm going skiing in Colorado next week where the forecast is like -17.
But do you feel that when you're skiing? I would.
You know what's really strange is they have a feels like temperature for Colorado that's higher than, I don't know how that works, how it could be higher than the coldest temperature.
You're near the sun if you're on a peak?
I guess I
have no idea. This is why I don't ski, because I'm perpetually cold, and that sounds totally unappealing to me. But that cold snap is real. I'm saying, watch the heating oil prices. I mean, with that kind of cold snap, that demand's going to take off.
Yeah,
Just
what's Natty doing?
And also, if it's that cold in Texas, then if you have any shut-ins, there's going to be maybe a little mismanagement there on supply and demand. Just saying, guys.
That's all coming our way, as well as in mid-America, so brace yourselves.
Definitely brace yourselves. Brace yourselves also because we will be taking this Senate Finance Committee hearing with Scott Bessent in just moments. Senator Lindsey Graham is still giving the introduction to Mr. Bessent. We will bring that to you as it begins. And Mike, what's your team working on? So Mike he heads up crypto. What are you guys working on with the new administration now coming in?
Well, as Nathan was saying, President Trump made a lot of promises to the industry that pretty much, dovetail exactly with what their wish list is. He promised to fire Gary Gensler as the SEC chair. Now, there's some questions over whether he legally had the authority to do that, but Gensler ended up resigning. So, that's one big one. That strategic reserve, I think, is a big question for the market. It doesn't seem to be a big groundwell of support for what Senator Lummis wants to do, which is actually buy 1 million Bitcoin over 5 years. But, we'll see once Trump gets into office what those executive orders look like. Will that be a priority to create that reserve day one and at least hold the tokens that the government already owns? And there's legal questions about that too, because as Nathan pointed out, many of them were seized in criminal cases. And typically what happens when the government seizes an asset is it's auctioned off and money is paid out to the victims of the crime. So
you keep it and you don't sell it. What about the victims of the crime?
Right, yeah. And so there might be, some legislation that needs to be tweaked to allow that to happen. Otherwise, I think, it's obvious that the industry really has Trump's ear right now. We see crypto CEOs paying visits to Mar-a-Lago all the time. There is a lot of expectations. What's brewing under the surface of all that, though, is it's hard to paint the whole crypto industry with the same broad brush. There's a lot of different priorities within the industry. Some would really like to see stablecoin regulations be the first thing. The tokens that basically track the U.S. dollar, like Tether or USDC, super important in the crypto industry because there's a lot of sort of these decentralized finance applications where you cannot actually bring regular U.S. dollars into. You have to convert them to a cryptocurrency like Tether and then take them there. And, it's a hugely growing space, something like 160 billion worth of stable coins out there right now. And not really any regulations safeguarding, how do you back up these things? Tether famously hired Cantor Fitzgerald and Howard Lutnick to buy treasuries, T-bills, to back up its stablecoin. And so, that's another dynamic at play there is Tether and Howard Lutnick are very closely related, do a lot of business together. So Tether has the ear of Lutnick. Lutnick has the ear of Trump. And as we all know, Tether has a really sort of colorful history in the crypto world, let's say. A lot of controversy, a lot of questions, reports that they're being investigated because those stable coins are really popular among sort of the shadier purposes of crypto, terrorist financing, that sort of thing.
I knew you knew all the stuff. Perfect person to ask. All right, Mike Regan, thanks a lot. You've been doing duty for this hour. We appreciate it. I want to take you now to Scott Beston in front of the Senate Finance Committee as he begins his testimony.
Over the past few weeks, I want to thank my spouse, John Freeman, who is here today, and my wonderful children, Cole and Caroline.
Mike, I'm not sure if Mike's here.
Who are sitting behind me.
Mr. Besson, could you pull the microphone a little closer to you?
Who are sitting behind me for the ultimate civics lesson. I want to acknowledge 3 people who couldn't be here today. My 98-year-old mother-in-law, Celine Freeman, a World War II French war bride of an American soldier who lives with us in Charleston, South Carolina, making for a 3-generation household. My sister, Paige McLeod Besson, who doesn't like crowds and prefers the mountains of South Carolina to large cities, and my recently deceased sister, Wynn Besson, who worked tirelessly as a public defender in one of South Carolina's poorest counties. I also want to thank President Donald Trump for having placed his trust and confidence in me for such an important role in his administration. While I've met with many of you, most Americans watching at home will be unfamiliar with my background. I have been blessed with a fulfilling and successful career, but my presence here today was far from predetermined. I was born and raised in the South Carolina Lowcountry. My father fell into extreme financial difficulty when I was young. When I was 9 years old, I started working 2 summer jobs, and I haven't stopped working since. I eventually made my way to Yale, I accepted my first internship in finance because the job came with a pull-out sofa in the office to sleep on, which allowed me to live in New York City rent-free. I've been involved in the financial markets ever since. I've been fortunate enough to work with some of the world's greatest investors in a career that has taken me to almost 60 countries over 40 years. My life has been the only in America story that I am determined to preserve for future generations. Today, I believe that President Trump has a generational opportunity to unleash a new economic golden age that will create more jobs, wealth, and prosperity for all Americans. My life's work in the private sector has given me a deep understanding of the economy and markets. And while this experience will be invaluable in crafting economic policy, I have long adhered to the principle that you should know what you don't know and lean on those who do. Having never served in government, I intend, if confirmed, to be in close contact with each of you in your offices and seek your counsel. The Treasury Department plays a critical role in protecting American national security. We must secure supply chains that are vulnerable to strategic competitors, and we must carefully deploy sanctions as part of a whole-of-government approach to address our national security requirements. And critically, we must ensure that the U.S. dollar remains the world's reserve currency. Today, Americans face significant challenges in an economy that has not created enough opportunities for working men and women. We have an affordability crisis, a housing shortage, and for the first time in my lifetime, parents feel as though the American dream is slipping away from their children. The federal government has a significant spending problem, driving deficits that have averaged an historically high 7% of GDP during the past 4 years. We must work to get our fiscal house in order and adjust federal domestic discretionary spending that has grown by an astonishing 40% over the past 4 years. Productive investment that grows the economy must be prioritized over wasteful spending that drives inflation. As we begin 2025, Americans are barreling towards an economic crisis at year-end. If Congress fails to act, Americans will face the largest tax increase in history, a crushing $4 trillion tax hike. We must make permanent the 2017 Tax Cuts and Jobs Act and implement new pro-growth policies to reduce the tax burden on American manufacturers, service workers, and seniors. I've already spoken with several members of the committee, as well as leaders of the House, about the best approach to achieving these important goals together. As President Trump has said, we will unleash the American economy by implementing pro-growth regulatory policies, reducing taxes, and unleashing American energy production. The breadth and depth of our capital markets, along with predictable pro-growth tax policy and smart updated regulation, will continue to make America the most popular destination in the world for starting, growing, and taking public a business. And as we rebuild our economy and lay the foundation for the next generation of American competitiveness, we must use all the tools available to realign the economic system to better serve the interest of working Americans. For too long, our nation has allowed unfair distortions in the international trading system. President Trump was the first president in modern times to recognize the need to change our trade policy and stand up for American workers. If confirmed, I look forward to working with President Trump and members of this committee to do just that. Members of the committee, these are just some of many important goals that President Trump has laid out for me and others on his economic team. I firmly believe that if confirmed, and with your counsel and support, we can usher in a new, more balanced era of prosperity that will lift up all Americans and rebuild communities and families across the country. I humbly thank you for your consideration and am eager to take your questions.
Thank you, Mr. Besson. Before I begin my questions, I want to re-emphasize how appreciative I am of your diligence in the process that we've gone through vetting here in this Senate. I appreciate the more than 3,000 pages of supporting material you've provided, as well as the countless hours you and your staff have offered.
You are listening
to
the Senate Finance Committee. You're currently listening to Chairman Mike
Let me be
Crapo
clear.
As he questions
You followed
Treasury
all of the
Secretary
applicable
nominee
law
Scott
and met the
Bessent.
committee's long-standing diligence standard. Your process matched that which has applied to nominees in every previous administration. And I want to go in my first question to you to the Tax Cuts and Jobs Act, which Senator Wyden and I have both mentioned already, and you've mentioned in your remarks. The attack on this statute, this law, which is law, I remind everybody it is the law now, it was passed in 2017, is that it was a tax cut for the wealthy. I appreciate you, Mr. Bessent, noting that it will be a $4+ trillion tax increase if we do not extend this law. And a point that I would remind all of my colleagues is that if that $4+ trillion tax increase happens, it's not just going to be something that impacts the wealthy. It is $2.6 trillion of it. The majority of it falls on people who make less $400,000 for a family with 2 taxpayers, under $400,000 per year. That's the number that President Biden chose to say he wanted to protect it. $2.6 trillion of this tax cut hits those making less than $400,000. Moreover, massive amounts of it hit pass-through entities, small businesses across this country. This is not a tax cut for the wealthy that we're talking about. It is a tax increase on all Americans, the majority of whom are in the lower and middle income categories. My question to you is, one of our pivotal tasks is to make sure that this tax increase does not happen. Can you give us your perspective on the impact that would occur in this country if we allowed this $4 trillion tax increase to happen?
Senator Crapo, thank you for this, and thank you for the meetings over the past few weeks. I've enjoyed working with your staff, and this is the single most important economic issue of the day. This is pass-fail. That if we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity. And as always, with financial instability, that falls on the middle and working class people. We will see a gigantic middle class tax increase. We will see the child tax credit halved. We will see the deductions halved. So it will be what we call in economics, it has the potential for a sudden stop. And as I said, traditionally with these sudden stops, it falls on working Americans.
Thank you. And I would just say to you, you may be aware of this, but the Tax Foundation has indicated that if we do sustain these tax cuts and protect them from expiring and stop this tax increase, that the extension of this policy would increase the growth of the GDP in the United States by 1.1% over time. Similarly, and I don't know how they came up with the same number, but the National Association of Manufacturers indicates that if we don't extend this tax relief, that there will be a 1.1% reduction in growth of jobs and development in our economy. It seems to me that as we are talking about what to do for America, that protecting America from a 1% reduction versus a 1% growth in GDP is a critical objective. Could you just give a little bit of perspective? I know you've just answered this question in another context, but could you just give a little bit more perspective on those kinds of dynamics? And I'm sorry, I'm going to try to keep to 5 minutes And we've only got about 15 seconds left of mine, and I want to be sure everybody else stays on time, so I will too. Could you quickly respond?
Well, Senator, I would just say that we saw the power of these tax cuts in 18, 19, and going into January of 20 before they were interrupted by COVID, and the great success that we had.
Thank you. Senator Wyden.
Thank you very much, Mr. Chairman. Let me say to the nominee, I've got 4 questions that I'm going to ask, and if we both can keep it brief, I think we can get to all of them, because I think it really frames.
You are listening to Ranking Member of the Senate Finance Committee, Ron Wyden, questioning Scott Bessent, nominee for Treasury Secretary.
Direct File. This is the program that helps our people who choose it to save hundreds of dollars when they file their tax return. Last year, the IRS launched it. It was enormously popular among taxpayers, but of course, the tax software giants and their big lobby just hate it. They want to shut it down. Now, the filing season starts January 27th, so it opens in 10 days, and millions of taxpayers around the country have already been notified that they are going to be eligible to use Direct File this year. So I won't do this for every question, but I'd really like a yes or no on this one. Will you commit to keeping Direct File up and running if you're confirmed?
I will commit that for this tax season, that Direct File will be operative, and the American taxpayers who choose to use it will. And if confirmed, I will consult and study the program and understand it better and make sure that it works to serve the IRS's 3 goals of collections, customer service, and privacy.
I appreciate the answer. It means that taxpayers are going to save, who choose to use it because it's voluntary, hundreds of dollars, and we'll have a chance to see once again how popular it is with practically everybody except the tax prep software crowd. On to tariffs. Donald Trump, with no plan and no strategy, says he's going to put across-the-board tariffs, blanket tariffs on all imported goods, which means that our workers and our small businesses are going to get clobbered with additional taxes on practically everything they buy from other countries. My question here is, who would pay these tariffs? Americans or foreign countries?
So, this, Senator Wyden, just to understand, so I can frame the answer correctly, do you believe that these tariffs are a consumption tax increase?
I believe these tariffs, you can call it whatever you want in terms of trying to gussy it up. They're going to be paid for by our workers and small businesses. And all through the campaign, we heard they weren't, that foreign countries were going to pay it. I think that's baloney. It's going to be paid for by workers and small businesses. So, your response?
Yes, Senator, I would respectfully disagree. And the history of tariffs and tariff theory, optimal tariff theory, does not support what you're saying. Traditionally, we see that the current, if we were to say use a number that has been thrown around in the press of 10%, then traditionally the currency appreciates by 4%. So the 10% is not passed through. Then we have various elasticities, consumer preferences may change. And finally, foreign manufacturers, especially China, which is trying to export their way out of their current economic malaise, they will continue cutting prices to maintain market share.
Okay. That's an academic view of it. But what I know is the history of this is it clobbers people of modest means. They're the people who are going to get hit. And all through the campaign, there was a big show that it was going to be paid for by foreigners, not so. 2 other questions that I want to get in. And I already made it clear, and you and I talked about this. I'm for a tax code that gives everybody the opportunity to get ahead. You and I talked about my friend Bill Bradley. He and I have been working for this for years. Do you believe the tax code should treat wages differently than it treats wealth?
Look, in any tax system that advantages and creates distortions, it is a change that, Senator, it is a decision that was made when the tax codes were written. And so every tax code involves the trade-offs and distortions in favor of other the gains.
It sounds to me like you do believe that it's fine to treat wealth more favorably. I couldn't disagree more. The idea that a dollar earned by a hedge fund manager has more value than a dollar earned by a teacher or a factory worker, I just think is a disconnect with the American people. One last question, and that is about the legislation that was written in this room that was the biggest transformation on clean energy in American history. That is our package that basically said the tax code as it relates to energy is a broken down mess. And we basically said we're going to have a technology neutral system. The more you reduce carbon, the bigger your tax savings. Now there is a big effort in the Trump administration to reverse it. I think that's going to be bad for the economy, but it is going to be damn good for China because we are in an arms race on clean energy with them. Are you going to be on the side of people who want to unravel this?
Senator Wyden, just so we can frame this for everyone in the room, China will build 100 new coal plants this year. There is not a clean energy race. There is an energy race. China will build 10 nuclear plants this year. That is not solar. I am in favor of more nuclear plants. And I would note that the IRA, as scored by the CBO, is wildly out of control in terms of spending on the upside.
Well, first of all, the clean energy package does protect nuclear because members on both sides of the aisle in this room wanted it to be that way. But if you're going to talk about fossils, the United States has achieved a greater level of energy security than we've had in generations. Oil and gas production is at record highs. And it's not just that, but it's about clean energy. And I'm very troubled by your position denying that we're in an arms race with China on clean energy, because we definitely are. Thank you, Mr. Chairman.
We do need to move on. And I told Senator Wyden he could have those 4 questions, but I want to remind everybody else we've got a 5-minute time limit. He deserved those extra questions. Senator Grassley.
Mr. Congratulations. I want to start out.
We are currently listening to the Senate Finance Chair Committee questioning Scott Bessent, Treasury Secretary, a nominee, currently speaking Majority Leader Chuck Grassley.
Chairman, we answer all of our letters, and everybody that comes to the Hill says yes, they're going to. And I said, maybe you better say maybe, because most people don't keep that promise. So I just wanted to remind you, if I write you a letter on my oversight responsibilities, I'd appreciate it if you'd answer it. Now to my first question. My Democrat colleagues believe, you gonna put that up? My Democrat colleagues believe the only solution to our unsustainable debt and deficit is higher tax rates and that ends up being on job creators and families alike. However, history proves that high tax rates fail to raise significant revenues. Taxpayers, workers, and investors are smarter than that. In other words, they're smarter than we in Congress that thinks that at one time a 93% marginal tax rate would bring in more revenue than a 70% tax rate or a 50% tax rate or a 30% tax rate or a 40% tax rate and so on. But as you can see from this chart, Congress isn't too smart because the taxpayers decide how much money they're going to bring into the federal treasury. Now, on the other side of the ledger, federal spending is at levels we've never seen outside of war and recession and still growing. So I'm making a statement to you, but if you'd like to comment on whether or not we have a fiscal imbalance primarily or a spending problem rather than a revenue problem.
Senator Grassley, I enjoyed visiting you in your office, and will remind you that when we were talking about the American agriculture, that I may be the first Treasury Secretary nominee in a long time who knows what a section is, 642 acres, and am involved in the farming business. And yes, we do not have a revenue problem in the United States of America. We have a spending problem. That historically, for the past 40 or 50 years, revenues, federal government revenues, have averaged about 17 to 17.5% of GDP. And spending has been slightly over that, leading us to a 3.5% budget deficit, which is manageable because we have roughly 3.8% nominal growth, 1.8% real growth, 2% inflation. Today, as you stated, and to be clear, this is one of the things that got me out from behind my desk and my quiet life in this campaign, was the thought that this spending is out of control. We are spending about 24, 25% of GDP. So as you said, 6.8 to 7% deficit. We have never seen this before when it is not a recession or not a war. And I am concerned because several times the Treasury of the United States has been called upon to save the nation, whether it was the Civil War, the Great Depression, World War II, or the recent COVID epidemic. Treasury, along with full government and Congress, has used its borrowing capacity to save the Union, to save the world, and to save the American people. And what we currently have now, we would be hard-pressed to do same.
My last question is one I ask a lot of people to come from Treasury. While I oppose tax hikes on individuals, families, and small businesses, I've long championed sensible policies geared towards shutting down tax loopholes and providing tools to IRS to detect tax cheats. A primary example is my legislation that I authored in 2006, the IRS whistleblower law. It's brought $6 billion back into the federal treasury. This program could raise billions more if IRS would use it to its full potential. So I hope I can count on you if you're confirmed, and I think you'll be confirmed, to be supportive of this whistleblower program and work to ensure its full use to its full potential.
Senator Grassley, we are in complete alignment on this program.
Thank you. Next would be Senator Cornyn.
Well, thank you, Mr. Chairman. Mr. Besant, welcome
You are
to
listening
Washington,
to Republican
D.C.
Senator John Cornyn. Question, Scott Besant, Treasury Secretary nominee in front of the Senate Finance Committee.
For most people who are not acquainted with it. I happen to represent a state that has the 8th largest economy in the world. We think we understand the formula for economic growth and prosperity and opportunity, which are low taxes, a reasonable and modest regulatory footprint, and opportunities for people to prosper, and by prospering, invest and create opportunities for other people to pursue their dreams. We think there's a lot Washington can learn from that formula, and it sounds to me like you agree. One of the strange experiences I've had here is that so many of our colleagues, principally on the other side, think that the money that you earn is not actually yours. It's the federal government's, and you just get to keep a little bit of it. Conversely, I believe that the money that people earn is theirs, and they have a responsibility to pay taxes. But as you point out, an over-tax burden or large tax burden has a way of depressing the economy and reducing standard of living. So I'm grateful for your nomination, and I think you are exactly the type of individual that needs to serve in this important position, and I support your nomination wholeheartedly. Let me ask you, in the short time I have, one sort of obscure question, and another one that we discussed in our office. As you know, the market for U.S. Treasuries is the largest market in the world at $28 trillion, and it's critical to the financial stability of the United States. There is actually a proposal for an entity to clear U.S. Treasury futures at the London Clearing House, which is overseen by the Bank of England. Some argue that the Bank of England would have control over a, heaven forbid, a default scenario in this critical market instead of the U.S. Is this a concern to you?
Senator Cornyn, I enjoyed visiting in your office, and I would note that while Texas has more arrivals due to good economic policies, South Carolina has more arrivals as a percent of the population, also driven by our wonderful governor, Henry McMaster.
I'm still going to vote for your nomination. I think it's 1,600 people a day in Texas, but go ahead.
Yeah, everything's bigger in Texas, sir. You raised a very important question, and one that I will investigate further. I was unaware until the past few days of this with the new exchange. What I can tell you is, as a student, a professor of economic history, that it is important for the U.S., for U.S. Treasuries, for us to be able to resolve any stress issues in the market in the U.S. We saw during the Lehman Brothers bankruptcy that many of the problems emanated from the UK subsidiary. So this is something that, thank you for bringing this to my attention, and my inclination is that the resolution authority must lie here in the U.S., but I will get back to you in writing with an answer on this if confirmed.
Thank you. You appropriately mentioned China as one of our biggest challenges. While I believe in free and fair trade, we know that some countries, principally the PRC and Chinese Communist Party, don't play by the rules. Over the years, by some estimates, U.S. investments in Chinese companies have totaled $2.3 trillion in market value. That was at the end of 2020. That included $21 billion. These are American companies investing in China. $21 billion in semiconductors, $54 billion in military companies, and $221 billion in artificial intelligence. So it's pretty clear to me that U.S. investments have fueled China's economic growth, which has allowed them not only an increased standard of living, which is great for the Chinese people, but problematically, it's also allowed them to modernize their military and now threaten the peace in the Indo-Pacific and beyond. As we discussed, I've introduced a bill that would require transparency of American companies investing in China. And of course, the entity that would receive the reports from American companies that do that, and since it's strictly a reporting requirement, would be Treasury. What's your view of an outbound investment transparency requirement?
Senator Cornyn, I believe that, as we discussed in your office, this is a very important issue. That the Chinese economy is the most unbalanced economy in the history of the world. They are using their surpluses to fund their military machine in China, and I'm not going to try the Mandarin pronunciation for the sake of everyone in the room, but there is a phrase that is two words: military industrial, and military always comes first. So we should understand that, and that we should have a very rigorous screening process for, as you identified, anything that could be used in AI, in quantum computing, in surveillance, in chips, that the U.S. has the lead, and we must make sure that we maintain it through smart policies such as you and I discussed.
Thank you. We need to move on.
Senator Bennett.
Mr. Besson, thank you for being here. Mr. Chairman, congratulations on your position. I look forward to working with you, as I always have. Mr. Besson, thank you for your willingness to serve. You're
listening to Senator Michael Bennett questioning Treasury Secretary nominee Scott Bessent in the Senate Finance Committee.
As alarming, and yet you're here with the same Trump tax policy that has burdened the American people with another $2 trillion of debt that their kids and grandkids are going to have to pay back. And despite the conversation we've heard over here, clearly, you know, the distribution of it was deeply, deeply, deeply unfair. 50% of it went to the top 5% of Americans. 75% of it, if you add the SALT, which even the Wall Street Journal won't support because it's so unbelievably outrageous, will go to the wealthiest 5% of Americans. The tax policy is one that's hard. It is, for some reason in this room, it makes sense to people. In America, I don't think there's been a mayor in the history of the United States whose tax policy has been to go to the people of New York City or of Atlantic City or even of Mar-a-Lago and said to them, I have an idea. I'm going to borrow more money than we have ever borrowed in the history of that community, and I'm going to spend it. And I would say, well, geez, I'm worried about that. I don't want us to borrow a bunch of money without knowing what it's going for. What is it going for? Is it going for schools? No. Is it going to compete with the Chinese in their defense? No. Is it going to pay for parks? No. Is it going to deal with the mental health crisis that we have in America? No. Is it going to pay to secure our border? No. What are you doing with the money, Mr. Besson? What were you doing with the money, Mr. Mnuchin? What are you doing with the money, Mayor, in America? The answer is we are going to give it to the richest people in America, the richest people in our community, and expect that somehow that's going to trickle down to everybody else. That has been the Trump tax policy since the day he showed up, and no mayor in America would ever, with a straight face, say that's what they should do. And in fact, no America in history has done that. But to add insult to injury, you sit here, and Mr. Mnuchin sat here at his time and said, it's all going to be paid for by economic growth. We know that's not true. We know it costs $2 trillion. So while the benefit went to the richest people in America, the cost is being borne by the children of working people all over this country. And that's what's going to happen now. It's $4.6 trillion this time, not $2 trillion. And then you come here, and this is my question, Mr. Besson, and you sneak into your opening statement that we have a spending problem, and what we have to focus on, as you said, is discretionary spending after your crocodile tears about how China is out competing us. And as you know, because you're a smart person, and you spent a lot of time on Wall Street, just like your predecessor did, discretionary spending is about a third of our overall spending. 17% of what we spend is domestic. 17% roughly of what we spend is military spending. That spending you were talking about with respect to China. There are so many things I think you owe the American people after we have seen the catastrophe of the result from the tax cuts the last time and the fact that the benefits went to the wealthiest people. But don't you at least owe the American people a refund for the $2 trillion that they've already incurred because of the last round before you get to the $4.6 trillion? Can't we think of a better idea in the halls here than cutting taxes for the wealthiest people and expecting that it will trickle down to everybody else when we have the profound needs that you have talked about? When we're living in an economy, you had the American dream. We heard you say that, where fewer and fewer people can get ahead, where this generation of Americans is going to be the first generation to leave less opportunity, not more, to our kids and our grandkids, where we see massive income inequality and wealth inequality when Trump was president, when Biden was president. Can't we think of a better idea than that? And at a bare minimum, and this is tiny, don't we owe them an answer about what you are going to do to that 17% of discretionary spending, or even the third, before you come in here and say that the most important thing we should do is cut taxes for the richest people in America?
Senator, thank you. And I would respectfully disagree with much of your categorization in terms of the benefits accruing to the richest Americans. Actually, the share of taxes paid by the upper percent of Americans increased after TCJA. It went from 39 to 46%. The top 50% of Americans now pay 98% of taxes, and working families had real wage increases in 2018 and 2019, and going into 2020 pre-COVID. The CBO scoring for the Trump tax cuts got rescored by 1.5 trillion.
Make sure, because we're in the beginning of a long debate, that if you're going to rely on the CBO score for this, that you're going to be willing to rely on it for the things that you said it's no good.
Look, I'm not in love with CBO scoring.
I know that. That's why now you're relying on it. So I'm just saying, it's not funny money. This is the American people's money. We can do math. Every mayor in America has to do math, and we're going to insist that you do the math too, because we know George Soros understands the math when you work there, and you understand full well what's going on here, just like Steve Mnuchin did. Just like Donald Trump does, and we're not going to let it happen against the American people. Thank you, Mr. Chairman.
Thank you. And I again remind my colleagues, we need to hold our time to 5 minutes. Senator Cassidy.
Mr. Basant, I'm always going to pronounce your name as if it was in South Louisiana.
You are listening to the Senate Finance Committee hearing of Scott Bessent, the incoming Treasury Secretary, if confirmed, currently taking questions from Senator Bill Cassidy.
Sometimes we get people here who just rope-a-dope, and they'll have a set of statements such as have been just delivered, and all due respect to my colleague, and they just rope-a-dope, and you actually give substantive answers. I thank you for that. By the way, I also, Lindsey Graham alluded to it, going back to tariffs, which Senator Wyden spoke of. I've been very concerned that countries like China manipulate environmental regulations. You point out that they're building 100 coal-fired plants over a period of time, and that whatever we do will not have an impact on global greenhouse gas emissions because China's putting up so many. I believe I've learned that that is called an externality in economics. When we met, we discussed the foreign pollution fee, which would put a levy, a tariff, on those carbon-intensive products coming from countries like China, roughly commensurate with their avoided cost of not controlling it. Now, I would think that my Democratic colleagues would like that, because that's clearly a way that they are manipulating the world economy to steal jobs from the United States and simultaneously increase global greenhouse gas emissions. Any comments on such a foreign pollution fee?
Senator Cassidy, I greatly enjoyed our discussion and the extensive presentation you gave me when I visited with you. And this is a very good question because, and I believe it is one for your Democratic colleagues to understand whether they would be in favor of the equivalent of a carbon tariff. That Senator Graham is in favor of it. And I think this is a very interesting idea that it could be part of a entire tariff program because I think President Trump hasn't taken office yet. But if confirmed, I look forward to working with him on various strategies, some that could be specifically aimed toward carbon, as you say, others that could be aimed toward unfair trade practices, unfair financing practices.
So if you will, there's externalities that a tariff can address. Those externalities in and of themselves hurt the pocketbook or the job prospects of an average American. Let me move on. I think you would agree with that. I applaud your goal to get our debt to GDP ratio down to 3%, or percent of our GDP down to 3%. But you studiously say that we can't talk about things like Social Security. And I think that's because routinely, if we talk about Social Security, we presume that there's going to be a cut in benefits or a raise in taxes. I think we spoke when we met. I and others have a bipartisan plan that would create a pension investment fund separate from the Social Security Trust Fund, and that just like we do with our 401ks, invest it in the broader economy and use the proceeds from that to offset the upcoming 25% cut in Social Security benefits that will occur if we don't address this problem. And just so folks get that, under current law, when the Social Security program goes insolvent in 8 years, per CBO, there'll be a 25% cut in benefits. Under the plan I and others have endorsed, it's a pension investment fund in which we, again, would invest in the broader economy with all the safeguards to keep the government from interfering. I mention that because it seems that other advisors to the president, incoming president, have spoken of creating an investment fund to benefit. Mr. Lutnick, I think, has. Mr. Paulson did on the campaign trail. What are your thoughts about that concept? I think they spoke about it as sovereign wealth. I'm speaking about it as a fund to bail out social. Not, by the way, all risk borne by the fund, none of the risk borne by the beneficiary. She would get her scheduled benefits. What are your thoughts on that?
So, Senator Cassidy, first of all, I want to emphasize that President Trump has said that Social Security and Medicare, they will not be touched. And I believe...
but I'm saying touch in a positive way, not cut benefits, not raise taxes, indeed increase benefits, and take that 25% cut off the table, just to make that clear.
No, I understand. And so those would not be touched. One of the tragedies of this blowout in the budget deficit is that we have to get our short-term house in order to start, before we can start implementing the smart plans such as yours. I do believe that there is discussion to leverage the asset side of the U.S. balance sheet, as we discussed in your office, in favor of a fund, whether it's a sovereign wealth fund, something, as you discussed, a supplemental fund. So that is very much in the mix. I look forward to getting back to you on it. President Trump hasn't taken office yet. If confirmed, this is something that I think could be very exciting, because we always look at the debt of the United States, and we have fantastic assets that could be earning, leveraged, or used for multiple revenue-generating opportunities.
Thank you.
Thank you. Senator Warner.
Thank you, Mr. Chairman. Congratulations. Mr. Besant, it's good to see you and enjoyed our meeting. I've got some specific questions I want to ask, but I don't want to litigate this now, but I do feel, as someone working with Senator Crapo and others.
You are listening to Senator Mark Warner. Question, Scott Bessent at the Senate Finance Committee at Scott Bessent's Treasury hearing.
And I'm looking at any kind of pro-growth policies possible, but I just respectfully want to say there is not an industrial nation, first world industrial nation in the world that gets anywhere close to meeting their revenue needs, and I'm not proposing that America spend anywhere like the Europeans at 17 to 18% of GDP. It's never happened historically. It's not going to happen in a Trump administration or future Democratic administrations. So I just, we'll have a time to talk back and forth on this, but I can't let some of this go without at least offering something that there's not an economist around that wouldn't concur. We got to bring down spend, but the revenue side alone is not, excluding that, we're never going to get to a balance. I do want to raise on a more positive note, again, something I worked closely with the chairman on, and actually worked with your predecessor on, and was very proud of that relationship. I disagreed with Secretary Mnuchin on a lot of things, but I found a lot of things to agree with him on. And one was a relatively narrow part of the financial sector called Community Development Financial Institutions, CDFIs. Under the previous Trump administration, we put about $12 billion in. This serves access to capital for underserved communities. Under Senator Crapo's leadership, we built a bipartisan CDFI caucus, 12 Ds, 12 Rs. It's tough to get 24 bipartisan senators to agree on anything. It's kind of low-hanging fruit. There are things we can do to continue to expand this area, creating a secondary market. We've got some bipartisan legislation there, trying to reward patient capital. A lot of these institutions now have tier 1 equity, but they've got to get patient capital. And again, Senator Crapo and I have worked with the current administration, would want to work with yours on something called the Economic Opportunity Coalition. But can you say a word or two about how you view CDFIs and this making sure that underserved communities get the access to capital so they can have their own American dream, how that fits into your lexicon?
Senator Warner, I enjoyed talking to you about CDFIs in your office. The early part of my career was as a financial services analyst, so I have a depth and breadth, and I believe that the breadth of the U.S. financial services industry is what makes the U.S. economy differentiates the U.S. economy from the rest of the world. And I think the addition of these CDFIs into underserved communities are very important.
Well, I appreciate that. And again, it's bipartisan. And there are, again, you understand markets well. If we could spark a secondary market in this debt, if we could leverage, and I'm talking about private capital, and I know that's what my colleagues like a lot, private capital, but we can leverage it exponentially. One of the things we discussed, and again, we talked about this in my office, and I don't want to, one of the things I was happy to hear, I feel very strongly that we cannot reward Vladimir Putin's aggressive, outrageous behavior in Ukraine. And I think the Ukrainians have performed remarkably. Obviously, they have manpower issues. I see this from the intel side on a daily basis. One of the areas that I think we have not done as well, and candidly, the sanctions regime, I don't think was as effective as it should have been. And I frankly think the Biden administration waited too late to put some of these additional sanctions on oil and tankers. The ability for Russia to retool. Listen, I hope if President Trump can settle this, hallelujah, the world would be better off. But one of the things we discussed in my office was the potential to actually increase the sanctions regime as a way to help further leverage that. Would you care to talk for a moment about that again?
Yes, so Senator Warner, I believe that the sanctions regime, especially, well, first of all, I would say in my adult life that the tragedy going on in Ukraine is one of the greatest tragedies of my adult life. And ending that as soon as possible, and any role the Treasury can play in that, if confirmed, I would like to do. As we discussed, I believe that the sanctions were not fulsome enough. I believe that I believe that the previous administration was worried about raising U.S. energy prices during an election season, and I am perplexed to see that National Security Advisor Sullivan, on his way out the door, is raising the sanctions level on Russian oil companies. And indeed, the oil prices in the U.S. are up about 9% this month. So what was good for that administration is being foisted on us. But having gone from, I think, low-level sanctions to mid-level, that if any officials in the Russian Federation are watching this confirmation hearing, they should know that if I'm confirmed and if President Trump requests, and as part of his strategy to end the Ukraine war, that I will be 100% on board for taking sanctions up, especially on the Russian oil majors, to levels that would bring the Russian Federation to the table.
And I will only take 30 seconds. Let me just get 30 seconds. Thank you for that, because I think it's important